earnings are exploding to the upside.
The market is very excited for this week.
We're all expecting great things.
We don't want to overthink the secular trade.
We're still in a really strong earnings environment for U.S. stocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, gearing up for a big one. 5 big banks on Wall Street kicking off quarterly earnings, heading into the last CPI print before the Fed's next meeting as a rebound in oil is piling the pressure on a divided committee. The Fed chair is heading to Capitol Hill.
Let's just frame this. It is the World Cup today of finance. We are seeing the finals of the World Cup in finance, given how much news is really going to be coming out. There are a couple of really big questions for the day. Number one, is the window starting to close on AI financing? How much momentum is there behind some of what we're seeing with inflation? And how much are you truly seeing a hawkish Federal Reserve? Chris Waller setting the tone. Will we get sealing the deal? Kevin Warsh saying something, anything today in Capitol Hill.
Get to the bond market first, shall we? 2s, 10s and 30s. Let's start with rates and start with the Federal Reserve. New levels on 2s, 10s and 30s. 2s close to 430, 10s around 460 and 30s comfortably through 5% right now. Governor Waller, if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. He got out front of Kevin Warsh, the Fed chair, over 2 days of testimony coming up.
And he pushed back against looking at a different metric, maybe the mean adjusted inflation metric that we've heard some discussion around, as somehow ameliorating the inflationary pressure underpinning this economy, saying no matter how you cut it or what measure you want to use, inflation is up this year with increases recently quite broad. How much are we going to see that reiterated by Kevin Warsh?
This move in crude won't help. Bring it up. WTI and Brent again this morning. A 2-day rally, and we add some weight to it this morning. Up by more than 3% on WTI. $80 a barrel. Brent crude breaking 85. Breaking 86, 88 this morning, and up by more than 4%.
The strikes continue in the region. The President of the United States is saying the blockade will begin once again by the U.S. military today. He's also saying, interesting, Iran's not able to charge a fee. He's saying now the United States will be compensated some 20% for allowing the passage. And remember the Houthis? They've been quiet for a while. They're getting somewhat involved by striking a Saudi airport. So things are getting a little bit more volatile, a little bit more hostile right now in the region, and you see that in the price premium in crude.
Who wants to translate this one? What does it mean to be the guardian of the Strait? What does that even mean?
May the force be with you, Luke.
And if you want to go through a certain path right now through the Strait, you pay a 20% toll to the United States. How does that even work?
So somebody put this into perspective. The toll that Iran was putting on different ships was about $2 million per oil tanker. A 20% charge by the United States would be about $30 million per oil tanker. So let's just, if we actually look at the finances behind that, that is untenable for pretty much any kind of investor or company that wants to transport some of these goods. That said, there is this question of if Iran's not willing to cooperate, how does the United States force its hand? And right now you can see that frustration, and it's essentially, we'll just take it over and push you out of the equation. Will that work? Will there be the political and financial will behind that? Will there be the allied support for a 30% or 20% tax? Probably not. Nonetheless, this is the path of travel.
I get it's uncomfortable, but this could be the muddled new normal. This could be it, a volatile negotiation filled with unworkable solutions, like the one in the last 24 hours, punctuated by a series of on-again, off-again strikes over the next 2 months.
Purgatory, where this is the standstill we are in, and potentially the higher oil price might push them back to the negotiating table, only for talks to fall through once again, and then we are once again back at this cycle. So the market's just going to have to get used to the tit-for-tat, start and stop of the negotiations and of the conflict.
More on the story a little bit later this hour. Later this hour, the earnings season story begins on Wall Street. We'll hear from JPMorgan. We'll hear from Bank of America over the next 60 minutes or so. So look out for those numbers over the next hour. Coming up, we'll catch up with Chris Verrone of Baird Strategas, facing down a morning packed with event risk. We'll speak to the former Deputy National Security Advisor, Victoria Coates, as oil breaks back through 80. And Gerard Cassidy of RBC as 5 big banks report quarterly earnings through this morning. We begin this hour with stocks little changed heading into this morning's data and a ton of bank earnings. Chris Verrone of Baird Strategas writing the following. With 99% of banks above the 200-day average, the group kicks off the 2Q earnings season on solid technical footing. Chris joins us now for more. Chris, good morning. Good to see you.
Great to be here, John.
Is that what your focus is on this morning? Because we've got CPI, we've got Fed Chair Warsh. Is it earnings front and center?
Yeah, I think this is going to start to take some of the attention away, both from the central bank and from Iran here. And, you know, our kind of main point here is when you look at kind of the setup of the bank stocks into earnings season, they are on very sound footing. Are they overbought in the near term? Yeah, they probably are. I don't particularly care because the underlying trends are so firm. These are still the relative leaders. After, frankly, what was a pretty funky, March, April period, the banks have really, since about mid-May, come back and reclaim the bar of leadership. And you see it not just domestically, it's true in Europe, it's true in Japan. Even with JGB yields up, it's true in Japan that these global banks continue to act really, really well. So I think it's difficult to get kind of too worked up about financial conditions here when financial stocks are still in pretty good shape.
Well, let's talk about the US banks and the kind of exposure you want right now. So let's say on the far side, you've got a pure play on capital markets, and on this side is a pure play on Main Street. The closer you are to this side, as a general rule of thumb so far this year, the best you've done. In terms of Morgan Stanley, Goldman Sachs, those stocks have been flying. Where's the sweet spot now?
So that's now generally been true for about 2 years. If you look at when Morgan Stanley and Goldman broke out, it was probably back in late 24, early 25. So they've really carried the flag of leadership the entire time. I think what's maybe a little unappreciated, though, particularly when you go down the cap scale, there are so many regional and small banks that are acting great here, that are in good long-term uptrends, that have just finally broken out to new multi-year highs. So it's more than just the capital market stocks, which clearly there's been a story there with the IPO boom. But it's when you start to migrate down the cap scale, you do get some exposure and some very good charts in these small and mid-cap banks.
Just to build on what John's talking about, it's almost Main Street versus Wall Street. You've got Wells Fargo on one side of the extreme, and then you got Goldman Sachs and Morgan Stanley on this side of the extreme. And it seems like we've seen the fees that potentially are coming from some of these IPOs, some of these issuances. Is it going to broaden out where we start to see true, robust borrowing and lending from consumers and the broader economy?
To the degree to it extends to consumers, I'm unsure. I would say this. When you look at the credit landscape, and put aside the private credit names for a minute, we can talk about that. But public credit conditions are still extremely benign here. I mean, double B spreads yesterday made new cycle tights. That's true here. It's true in Europe as well. So I think, again, with bank stocks generally still in uptrend across the world, credit conditions pretty benign, I think it's premature to get too worked up or too bearish here. Listen, I recognize where we are seasonally. You can get a correction here for any reason into August, into September. We've seen that historically. But I think the underpinnings of this market are still in decent condition.
One big anxiety right now in markets is how long can this last? This incredible issuance boom, this incredible financing condition for anything related to AI. And we've gotten the sense that maybe in the margins it's starting to come back a little bit. Do you expect to get a sense of that, the sort of forward pipeline, or just whether it's starting to close?
So, Lisa, our kind of big view this year is that there is some interest rate out there where bonds simply become more competitive to stocks. And I just don't think we have found that interest rate yet. So to answer your question, when does kind of the capital markets boom end? I think it's when we find a bond yield that is meaningfully higher than where yields are today. We learned a couple weeks ago, I think the highs were 467 on 10s. That's not the level. It's some level meaningfully higher. People forget, go back to 1999 when you were in that NASDAQ melt up. Bond yields that year went from 4 to 7 in the U.S. So it typically takes a yield so much higher than the consensus believes to truly be competitive. So I think we're in this environment where money is just sloshing around from group to group to group, but it's very reluctant to leave the asset class of equities.
Are you calling for 7% 10-year
No,
yields?
I'm just saying that it takes a yield much higher than what the consensus believes is right in front of them. I don't think 461 this morning is that yield that ends this kind of 17-year bull market that we've been in.
Is July 29th the first rate hike?
I think not. I don't think we get a rate hike in calendar year 2026. I'll give you 3 things to think about. Number one, I think, is the one we all know. Look at forward inflation expectations. They're relatively anchored by any metric, whether 5-year forwards or even just 5-year forwards.
Is that because the market's priced for hikes?
Well played. Yes. Listen, I think the shift in narrative this year has been so dramatic. We got to get back to center here a little bit. Let's think about some of the data. Number one, PMI right now is 53.5. Fed doesn't hike from there. Just look historically, that's not where your majority of hikes come from. The 3-month average on payrolls right now is about 125K. If you look at a distribution of Fed action, when the 3-month average of payrolls is in that 100 and 150 range, the likelihood of a hike any point over the next 6 months is less than 20%. So whether it's the payroll data, whether it's the PMI data, I think the likelihood that we get this Fed in particular moving to hikes in 26 is low. Reserve the right to change that opinion should the facts on the ground change, as always, but that's kind of the job of what we do. I'd be betting no hike here.
Even though Governor Waller yesterday made it very clear he's very concerned about inflation and also talked about he doesn't want to repeat the mistakes of the past.
Waller's not the chair. And I think we all need to come to this realization. The chair is the chair. Let's get back to that mentality. The chair is the chair. I think, as we've seen with these task forces, we're going to get less and less communication from regional Fed presidents, Fed governors. So I'm more inclined to kind of discount what Waller said yesterday. I think that at the end of the day, the likelihood this Fed goes in 26 is still low. That's how we're positioned. That's how we're thinking about things.
It's interesting you don't think the centre of power at the Federal Reserve has shifted somewhat, because I've witnessed a committee vote down a chair before. In that case, it was the Bank of England governor of a QE coming out of the financial crisis. He wanted more. The committee voted against him a couple of times, I believe, if my memory serves me well. The situation at the Fed, you don't think it's shifted? Just give us the why.
I think at a minimum, these task forces over the next 6 months do buy the new Warsh Fed time to kind of get an understanding of the new lay of the land. I also think the data is just not there. Right? At the end of the day, if this is a data-sensitive Fed, the data is not there, whether it's payrolls, whether it's manufacturing. I also think when you look at 10-year yields, are they escape velocity here? I would hardly say that. I mean, twos, you can make a case. Hey, twos are, 425 this morning. They're 50 bips above Fed funds. That's probably the one signal that I would say maybe pushes back in my view here a little bit. I wouldn't say it's as extreme as what we saw in late 21, early 22. I think by the time the Fed got around to hiking in early 22, the two-year yield was something like 200 bips above where Fed funds were. So we're not yet in that category, but watch the two-year yield here. That would probably be the one thing that would start to shift my mind.
Chris, it's good to see you.
Always good to see you.
As always, thank you, buddy. Chris Verrone there of Strategas. Looking ahead to the data later this morning, 8:30 Eastern time, we get CPI. To Chris's point, and he's absolutely right, we've broken down to twos at 430-ish, tens around 460 again, and this equity market hasn't really broken down in a material way in the face of what we've seen in yields.
So I would love to play, yield roulette, where you start to figure out what that level could be that could start to crimp capital markets. And if you do have easy financing conditions, you have to start asking, should we? And how many people are going to say that? Are we appropriately borrowing and lending at a time where there seem to be parabolic moves? And I think increasingly people have been asking that question.
I think that's part of the conversation at the Federal Reserve right now, that's for sure.
I think it is.
More bank earnings later on this morning. We get JPMorgan and Bank of America this hour. Look out for that. Equity futures right now just about unchanged. With an update on news worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Good morning, John. President Donald Trump reinstating the U.S. blockade of Iranian ships transiting the Strait of Hormuz. Trump also demanding a 20% reimbursement for all cargo shipped through the waterway. U.S. military forces will resume the blockade, he says, at 4 p.m. Eastern. Fed Governor Chris Waller says the central bank may need to raise rates soon, speaking to tame inflation.
Unless I see evidence of a significantly weakening labor market, my focus from here on out will be on inflation. And no matter how you cut it or what measure you want to use, inflation is up this year. Even accounting for the likely temporary direct effects of the oil price shock, it is running at levels inconsistent with the FOMC's 2% objective.
Or CPI data out at 8:30 this morning, PPI out tomorrow. Samsung may be exploring a potential offering of ADRs. Sources had been telling us here at Bloomberg the company held preliminary discussions with bankers. Samsung, though, responding to our reporting, saying via text message it's not reviewing the possibility of issuing ADRs. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. The amount of equity supply already. SK Hynix tapping the equity market stateside for $26.5 billion. Alphabet monster capital raise earlier on this year. We had a record IPO from SpaceX. It's really difficult to keep up. We'll talk about the banks a little bit later this hour. They're going to make a ton of money from all of that supply. But at some point, that supply becomes a problem for the market, doesn't it? Not now, but at some point.
Yeah, I mean, maybe that's what we're seeing on the margins with SK Hynix in terms of the incredible volatility there. You have to wonder, given how successful these IPOs have been, why wouldn't Samsung issue ADRs, given the valuation here in the United States?
We'll have that conversation later this hour. Up next on the program, controlling the Strait of Hormuz.
We're putting the blockade back. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing.
How do you do that? We'll speak to the former Deputy National Security Advisor, Victoria Coates, in just a moment. Live from New York City this morning. Good morning. What a morning. Coming up later on this morning, this hour, we start with two of the 5 banks reporting earnings. We'll hear from Bank of America and JPMorgan. Later on, CPI data at 8:30 Eastern Time. Then after that, we'll hear from the Fed Chair, Kevin Warsh, on Capitol Hill. Look out for that a little bit later this morning. Equity futures into all of that negative on the S&P by just 0.1%. A bounce back on tech. The Nasdaq 100 up by 0.4 yesterday. Yes, we've got a bounce back in crude, and that's driving this move in the bond market. But in addition to that, it's Governor Chris Waller. 2s right now close to 430, 10s at 460, 30s at 5.1%. I think we all had a similar question. How live is the meeting in July in a few weeks' time? Turns out it could be quite live after this data later this morning.
After his speech, it ran to almost a 50-50 chance when in the Fed funds futures market, because people are looking at commentary like all it would take is a little bit more of a sense that inflation was picking up in that broadening sense that he's already seen. Any way you slice it, he said inflation is broadening out. What is the threshold? Does this mean that a hot print today could really put him in a hiking position? And then what will Kevin Warsh say to that later today?
This won't help. WTI 80, Brent crude around 87, under surveillance this morning, controlling the Strait of Hormuz.
We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing. We're controlling the Straits. We're putting the blockade back. I want to be reimbursed because we're protecting a very rich portion of the world.
So here's the latest this morning. Crude climbing as the U.S. reinstates its blockade of the Strait of Hormuz, with President Donald Trump demanding a 20% fee on cargo shipped through the waterway. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John. Good morning. Well, the U.S. is set to reinstate the naval blockade at 4 p.m. Eastern today, as the U.S. is looking to gain any sort of leverage when it comes to the Strait of Hormuz. We haven't gotten additional details from the White House when it comes to the president's proposal for that 20% reimbursement, though it could work out to some of the largest crude tankers paying more than $30 million per trip. Now, President Trump has previously floated that he would like to see the U.S. compensated for helping to secure the Strait, but this move would mark a reversal from what has been weeks of the Trump administration saying that freedom of navigation means that there should not be a price tag involved. But it's very clear here that the U.S. is trying to gain some sort of leverage when it comes to the Strait, considering that we saw the U.S. military last night conduct another wave of strikes seeking to degrade Iran's capabilities when it comes to striking commercial shipping. But even with the escalation, the UAE's defense ministry did confirm that 2 of its tankers were hit, and data is showing us that traffic in the Strait has reached its lowest level on Sunday, according to what was analyzed by Bloomberg News. Now, the region, John, is bracing for the next steps, and I will point out that President Trump today is set to meet with Iraq's new prime minister, as the White House is pressuring that leader to disarm proxy groups that are operating in the country, as we keep close eyes on some other Iranian proxy groups, including the Houthis in Yemen and some recent attacks that we saw from them overnight.
Tyler Kendall with the latest. Tyler, thank you. We'll catch up with Tyler again later this morning. To build on this conversation, we can speak to the former Deputy National Security Advisor, Victoria Coates. Victoria, welcome back. I'm struggling with this one, and I need your help. Is this a serious policy proposal from the White House?
Well, good morning, Jonathan. I mean, if you're talking about the move through the Strait in terms of the policy proposal.
Oh, that's precisely what I'm talking about. Yeah. Becoming the guardian of the Strait and charging a 20% toll.
Well, but I don't see this as a toll. I see this as the United States sharing the costs of securing the Strait. And so that's what's different. If you're paying a toll to the Iranians, you're paying them to not shoot you. If you are sharing a cost with the United States taxpayer is bearing a burden to try to keep that waterway open. And so this is something very different. You're just simply sharing a cost. So I think that's perfectly logical if that's how the president wants to arrange it. But the whole point is we need to keep that energy flowing. And what we've seen recently are prices coming down around $75 a barrel. That's right around the sweet spot for the United States. They're coming up today closer to $80 a barrel. Would prefer to have that lower. So no, I think this is a good security arrangement. I do think the Gulf is perfectly capable of paying for its own security. So I don't see this as a total.
Oh, the Gulf has got the means. I'm totally with you. They've got the money. That's not in dispute this morning. Victoria, my struggle is the US has failed to demonstrate they have the ability to open the Strait and get traffic through the Strait back to pre-war levels, regardless of whether someone's got the means or not. Does the US have the capability to achieve what they're talking about achieving?
No, I think we do. And we also, I mean, there is a plan in place that CENTCOM has that will clear the Strait. It would be fairly destructive to do, so I think the president would prefer not to do that. But if he has to do it, he does absolutely have the means at hand to do that. And I'd look at also where we struck last night. I was interested in the strikes on Bashir, which is one of the port cities along this side, also with an important nuclear program element to it. So they're starting to go after those targets, which degrade Iran's infrastructure, also going after their nuclear program. I think you're going to see those strikes continue over the next week or so.
Victoria, what do you make of the fact, though, that the industry has been somewhat caught off guard? The oil and gas industry, the shipping industry, they're caught off guard with the fact that this is an international waterway. Now, the president wants to make a new precedent where basically they have to give back to the United States some 20% to pay this fee to go towards the security of it.
Well, Annmarie, I mean, that's precisely it. That's going toward the security of that waterway. We're not the ones who have clogged it up. It's the Iranians who started making this an issue of you're going to get shelled if you go through. And I think 2 UAE ships or vessels rather, were hit overnight. There was another one. I mean, they're just taking pot shots at these tankers as they're going through. This is on the Iranians, not on the United States. And if we are going to expend the treasure and put our people in harm's way to clear the Strait to make sure that these vessels can go through, I don't think it's unreasonable to expect others to share in that cost.
Hasn't the Fifth Fleet always been the, quote, guardian of the Strait? Hasn't our Navy always been there?
Well, I mean, not always. I mean, since 1979, when President Carter, or 1980 rather, declared the Carter Doctrine, that we were dependent on the flow of energy out of the Gulf, and we would ensure that it would be coming out. I mean, but now we're in a very different position, and I think that's a really important point. That when Carter made that declaration of the Carter Doctrine, we were dependent on that energy. We now aren't. And I think we just hit a recent high of about 13.6 million barrels a day that we're producing in terms of oil. I mean, the next closest two are Saudi and Russia at 9 and change. So we are now the world's largest energy producer. We're in a very different position vis-a-vis the Gulf. I mean, we don't, for our domestic purposes, have to have that energy. Now, we are a part of a global energy market. We don't want there to be huge price spikes based on what's coming out of the Gulf. But that's less of an existential threat to us. So yes, that's why the Fifth Fleet is in Bahrain. But I'm curious to see going forward if that's something that we need to have there.
Let's hope that we can avoid another spike. Victoria, it's good to catch up with you. Victoria Coates there, the former Deputy National Security Advisor. We've got another one this morning, up by close to 5%, $87 a barrel. It is an international shipping waterway. Shouldn't have to pay anyone. Does the Middle East have the means? Absolutely. The willingness, I've got no idea. But do we have the capability? The military might, to actually keep that strait open. What I've seen so far is that is difficult, much harder than it is to say you can. Coming up on the programme, Gerard Cassidy of RBC. Big bank earnings set to report. JPMorgan, Bank of America, up next. Live from New York City this morning. Good morning. Coming up, earnings from Bank of America and JPMorgan. Dropping right now, numbers from Wells Fargo. Looking at an upside surprise on investment banking fees. Expecting to see a whole lot more like that throughout this morning and into tomorrow. Fees coming in at 939. The estimate was 830.2. This, of course, not a pure play on capital markets and investment banking, anything but over at Wells Fargo. A bit of an outlier compared to what we'll be talking about later on this hour.
Yeah, they don't necessarily have the same capital markets heft as, say, a Goldman Sachs or a Morgan Stanley or even a JPMorgan. They also have been lagging behind, as you pointed to earlier this morning, this idea that they have been the worst performing bank out there. That said, the fact that even Wells Fargo could come in with investment banking fees above expectations at $939 million versus the estimate $830, even as they can reaffirm their full year net interest income forecast, this gives a sense of just what we can expect from some of the others.
Yeah, net interest income, the big number for Wells Fargo. The second quarter coming in at $12.32 billion. The estimate $12.32 billion. The stock this morning positive by about 1%. Equity futures more broadly, your scores look like this morning on the S&P 500. Equities just about unchanged. On the Nasdaq, bouncing back for tech by 0.4%. In the bond market, new levels to talk about. Thank you, Governor Waller. 430, close to that level on twos. 10s through 460, 30s through 5.1%, in addition to some hawkish comments from the Fed governor. This move in crude as well. WTI and Brent pushing higher once again, breaking 80 on WTI, breaking 87 on Brent crude. As I'm discussing the oil numbers, JPMorgan drops as well. Some of these numbers coming out a little bit earlier than expected. JPMorgan dropping now. Bank of America will come in just a moment. Let's work through this together, Bramo. We've got adjusted revenue coming in at $58.02 billion. The estimate was $51.39 billion. I think it's fair to say that is an upside surprise. Investment banking revenue coming in at $3.9. The estimate was $3.06. Fixed sales and trading revenue at $6.05. The estimate $6.29. So that's a little bit lighter. When it comes to equity sales and trading revenue, though, check out this number. $6.03 billion. Okay, $6.03 billion. The estimate, 3.98. I think that is what you call a mega upside surprise.
I don't even know what you call a $2 billion beat at this point, given the fact that it is an upside surprise that almost doubles where the estimates were. Ultimately, this has been a quarter that was defined by those share sales that we've been talking about, by the IPOs, by some of the volatility, the single name and sector related volatility that evidently is the good type of volatility. Just looking through this, not everything was exactly a beat. I mean, you could see just managed net interest income came in just a touch light. Nonetheless, all around a really big quarter tied to exactly what we've been talking about, the IPOs, the share sales, the volatility that's been bouncing around, the ball of money that is moving but not necessarily moving down.
That equity sales and trading revenue number is a monster. The stock is down by about 0.75% this morning. Of course, the bar was already high coming into those numbers. So we've had Wells Fargo, just had JPMorgan. We'll spend some time on that in just a moment. In a few moments' time, a few minutes away, should be in the next 10 minutes, we'll hear from Brian Moynihan's Bank of America. Before we get there, 3 hours away from the cash open, let's get you some morning movers. Yahira has more. Hey, Yahira.
Hi, John. We are seeing SK Hynix ADRs bouncing back up 6.6% in the pre-market after falling more than 9% yesterday. The rebound follows a recovery in South Korea overnight, reinforcing Korea's growing role as a key barometer for the AI trade, and also showing how this company, SK Hynix's U.S. listing, is increasingly linking trade between the U.S. and Seoul. Meanwhile, the memory and chip stocks are also bouncing back this morning, with names like Micron up 3% in the pre-market after yesterday's sell-off and after a volatile stretch for these stocks, as investors continue to grapple with this concern that the wave of spending by memory companies could flood the market with chips, putting pressure on prices and, of course, eroding all this pricing power that they've enjoyed during this AI boom. And we end on Apple, seeing some pressure after some sell-side action, down 1.1% after KeyBank downgraded the stock to underweight, saying expectations for iPhone demand may have gotten a bit too optimistic. The firm thinks that U.S. carriers are going to pull back on subsidies, and that means fewer people upgrading their phones and less revenue for Apple services. And with its high valuation, KeyBank thinks that this dynamic makes the stock look unfavorable. The stock is up 17% year to date, outperforming the Mag 7. John?
Yahara, thank you. Thank you for the update. This line from Jamie Dimon at JPMorgan, the CEO and chair. Revenue in each line of business hit a new record. That's quite a line coming out of that bank. after 2Q.
Yeah, especially given some of the monster earnings that you've already seen in revenues coming from this bank, talking about how there has been incredible strength, particularly in capital markets. Jamie Dimon goes on to say the U.S. economy has demonstrated notable resilience this year with stronger business investment and hiring, the strength being supported by AI-driven capital investment, fiscal stimulus, and the benefits of more efficient regulations, so that sort of deregulatory push. But going on to highlight the risks, as Mr. Dimon is wont to do, including potentially sticky inflation and some other geopolitical risks that we have continued to talk about, particularly in the Middle East.
Stock is down in the pre-market by just 0.5% on JPMorgan as we get 5 of the biggest banks on Wall Street reporting second quarter results this morning. Wells Fargo and JPMorgan first out of the gate. Bank of America expected any minute now. Gerard Cassidy of RBC writing, we remain positive on bank stocks over the next 12 months. We expect to see continued stronger loan growth, a positive yield curve, and the return of excess capital. Gerard joins us now for more. Gerard, welcome. This line from Jamie Dimon saying the following: results are the product of a particularly favourable environment. I think that's an important issue right now, Gerard. The weather was good. Is the weather going to be good in the quarters to come?
Jonathan, you put your thumb right on it. The weather is very good. It's an environment that's very positive for the banking industry, as Jamie Dimon has pointed out. The economy remains very resilient. Loan demand is picking up. The capital market numbers that you guys have just discussed are incredibly strong. And now the real question is, what does the next couple of quarters look like? And I think it's going to remain robust. We'll see, obviously, the third quarter is a slower quarter for capital markets due to the seasonality, but you have a very strong ECM calendar still with the IPOs potentially coming this year. And then I think Jamie pointed out the regulatory environment is as good as it's going to get, Jonathan, and that's a real big tailwind for the banks.
Jared, I want to talk about the kind of bank you want exposure to right now. I've been talking about the banks as a group on the S&P trading at record highs. But within that group, you've got some real performance dispersion, so to speak. The closer you are to Wall Street, the better you are right now. The closer you are to Main Street for the stock, the more of a struggle. Jared, where's the sweet spot for you for the year ahead?
I think the sweet spot, Jonathan, is on Main Street. The large money center banks and investment banks have had a very good run, and we've been constructive on them, but the valuations are very full. And you're going to need a continued record pace, I think, for those stocks to continue to work, which we may get. But what's interesting to us is that the steepening, the loan growth, anticipated improved loan growth, a potential healthy yield curve for the banks makes Main Street maybe more attractive than it comes to the Wall Street banks or investment banks. The other thing, too, Jonathan, the year-over-year comparisons become more difficult on the investment banking numbers in the second half of this year, and certainly the first half of 27 when you compare them to the first half of 26.
I'm struck by what you're talking about, Gerard, which is that Main Street's going to have its revenge or its comeuppance with respect to Wall Street. I'm noting that at JPMorgan, the charge-offs were below expected at $2.37 billion versus the estimate of $2.6 billion. Wells Fargo also seeing a much lower charge-off number than previously expected. What does this tell you about the acceleration in the U.S. economy, despite some of the concerns that Jamie Dimon flagged, in particular, stickier inflation?
It's interesting because credit has been very resilient. I think investors are finally recognizing that the banking industry post-financial crisis has been de-risked. Then you had the 2023 March Madness when, of course, Silicon Valley, Signature Bank, and Republic Bank failed. And at that time, Vice Chair Barr of the Federal Reserve brought out that summer the first Basel III proposal, which was very onerous. And banks had to go on at the time what they referred to as risk-weighted asset diets, shrinking their loan books. And so the banks, I think, have underwritten their loans very well. But this resilient economy is a main reason why the credit picture is as strong as it is.
Gerard, there's a routine that JPMorgan goes through every single quarter that always makes me smile. You get a headline from Jamie Dimon and he talks about risks shifting below the surface like tectonic plates, and then a few minutes later they raise the outlook. And Bramo, that's just what JPMorgan did again.
So after raising it, then lowering it earlier this year, now they see full-year net interest income of about $105.5 billion versus the $103 billion. So superseding the previous revision that they had downgraded earlier this year that caused a sell-off in the shares, now coming out and raising it once again above where it initially had been.
Gerard, I'm not trying to get in trouble, but on earnings day, is it worth listening to Jamie Dimon?
Of course it is. Gosh, he's obviously iconic, and he's the real leader of the industry. And you got to parse through his words, no doubt about it. But, oh, my God, yes, he's definitely someone to listen to.
You know why I say that? Because he talks about risks every quarter, and they just keep raising the outlook, and they did that again this morning. Also, this line as well, Gerard, let's talk about this. Full-year expense guidance boost due to higher volumes. What's going to happen with expenses in the year to come, Gerard, in a world where we're talking about a backdrop of technological developments, maybe taking out labour costs?
It's interesting, Jonathan, because when you look at the expense increase, and I expect this from others as well that have investment banking and trading businesses, the numbers are very strong. And those individuals that are have incentive comp are going to see higher comp because of the stronger results, which I think is contributing to those higher expense numbers. And when it comes to AI, we're not expecting it to be a cost reduction measure just yet. It's more of a productivity enhancement tool than it is reduced costs.
Gerard, it's good to see you. You're going to stick with us. Gerard Cassidy there of RBC, breaking down the numbers from JPMorgan. We'll hear from Bank of America in just a few minutes. The standout line there, the headline, record revenue across each business line, Bramo.
It gives you a sense of just how well things are doing on literally every single front. You asked the question, just what kind of forward visibility do we have about how long this lasts? And ultimately, that is the key question for a lot of these banks. It's clear that Jamie Dimon is worried about some of those risks that are percolating, the tectonic shifts that are occurring under the surface. Nonetheless, there have always been those worries. Key issue is it seems like things are going very strongly, and you're getting this not only from the capital markets, but also on the Main Street side.
He often likes talking about the weather, right? Storms on the horizon, hurricanes, all that stuff.
Yeah.
This was a heat wave in 2Q for investment banking, right? And capital markets.
I think that is fair to say. It is a heat wave. Question is it going to be a heat wave akin to the one that we've seen over the past couple of months, particularly over in Europe, which we hear a lot about? Or is it going to be a heat wave like the one that we're going to get this week, and then it's going to fade by the weekend?
Stock is down by 1%. Don't get burnt. Forgive me. All right, let's get Bank of America in just a moment. Before we get there, let's get to the Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. U.S. Central Command saying it completed the latest wave of strikes on military targets across Iran. President Donald Trump saying the U.S. will hit Iran hard again today. Trump telling reporters the strikes target the country's capabilities for anything having to do with Hormuz. South Carolina's governor appointing the sister of the late U.S. Senator Lindsey Graham to serve out the remainder of his term through January. Her appointment comes as Republicans prepare for an August primary to choose the party's candidate for a full 6-year term. And turning back to the banks, JPMorgan reporting second quarter sales and trading revenue that beat Wall Street estimates. CEO Jamie Dimon saying revenue in each line of business hit a new record thanks to a favourable environment. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thank you for the update. Up next on the programme, it's a high bar for the big banks.
We're all expecting great things, right? But can the mega cap banks really exceed the mega expectations that have been put on? There's sort of a potential for earnings downgrades because of higher deposit costs versus the fantasy of the capital markets revisions continuing to go up and up and up.
Bank of America dropping right now. 2Q trading revenue, $7.16 billion. The estimate, $6.21. It's another upside surprise. We'll break down the numbers in just a moment. It's going to be a high bar for this earnings season for the big banks, and you can see that with JPMorgan. The stock is down by 2.25% in the pre-market following record revenue across each business line. That's JP. Bank of America out of the gate just moments ago. The stock is higher by 1/3%. Another big number for equity trading. The number is $3.62 billion. The estimate was $2.69, a record for sales and trading revenue out of Bank of America, up some 33%, a record for equities as well. Investment banking fees at Bank of America up by 50%. The numbers just phenomenal. Brian Moynihan calling it an exceptional quarter for our markets-facing business.
Yeah, ultimately riding the same tailwinds that we've seen from all the other banks, talking about how trading revenue ex-DVA was at $7.16 billion versus a $6.2 billion number. So really beating across the board, not just in the equities business, but also FICC, which we saw was a little bit different over at JPMorgan. Key questions here, as we've talked about, how big is the pipeline going forward? Is this as good as it gets, or is there some more under the hood? Also, are people going to start comparing which bank executed best, who is grabbing share under the surface? And that, I think, is what's going to be scrutinized after this.
The difference between the environment, a good one, and execution, we'll try and make that distinction throughout the next 24 hours. Looking at the banks then, Bank of America up by 0.8%, JPMorgan down by close to 2%. Under surveillance this morning, it's a high bar for the big banks.
We're all expecting great things, right? But can the mega cap banks really exceed the mega expectations that have been put on? It's going to be difficult to stand out. There's sort of a potential for earnings downgrades because of higher deposit costs versus the fantasy of the capital markets revisions continuing to go up and up and up.
So here's the latest this morning. Wells Fargo, JPMorgan, Bank of America kicking off a blockbuster day for earnings. Results from Goldman and Citi during the next hour or so. Gerard Cassidy of RBC has been standing by, working through the numbers. Gerard, welcome to the programme. Welcome back, I should say. Let's get back to this. The numbers from Bank of America just moments ago. Really good numbers. Records in some places. The name is up by some 1%. Lisa's asked the question. We heard from Erica Najarian of UBS just yesterday. The bar is so high, Gerard. Is this as good as it gets for some of these bank stocks?
That is the $64,000 question, Jonathan, is how much has been priced into these stocks? And when you're trading at 3 times tangible or over 3 times tangible book value, in the case of JPMorgan, there's quite a bit of optimism priced in there as well for Goldman Sachs and Morgan Stanley. Bank of America, on the other hand, doesn't trade as high as those multiples. Obviously, it doesn't have the profitability yet of those companies, so there might be more upside there in the Bank of America number. But that, it's a hard determination of what's priced in, and that's the valuation call that investors have to make. And just like art, it's in the eye of the beholder whether the stocks look cheap or not when you compare them to the non-banks in the Mag 7 or any of the semiconductor stocks.
How do you determine, Gerard, what is execution versus riding the tailwinds of the overall economy?
Riding the tailwinds of the overall economy, and in particular the capital markets, is a huge impact on everybody's numbers this morning. And you saw it in 2021 when you take a look at the numbers that banks put up back then. When you remember the SPAC IPOs were very strong. And then when that fell off in 2022, revenues fell, in some cases, in investment banking by 50%. So a good portion of what we see today, of course, is market dependent. But execution is also important. And the big players have the economies of scale, and they're gaining market share, as evidenced by some of these numbers.
I'm looking right now, JPMorgan shares are falling after looking at or at least some people are attributing it to the full year adjusted expenses of about $107.5 billion versus the expectation of $105 billion. Bank of America second quarter compensation came out a little bit below expectations. I'm just wondering how you view compensation expenses in the scheme of overall performance. Does it matter to you, or is this just an excuse to sell really highly priced shares?
It may be more the latter, Lisa, because we're more focused on positive operating leverage than the actual expense number. And what I mean by that is, if revenue growth, the rate of growth, exceeds the rate of growth of expenses, that's what you want to see, because that leverage drives better earnings per share growth. And as a result, yes, you'd like to see expenses kept in check. But if you're growing revenues in incentive comp type businesses, where the folks that drive those revenues will be incentivized with higher compensation, then of course you want to see those expenses rise, because that means revenue is rising. But positive operating leverage takes precedent, trumps, if you will, the actual level of expense growth, in our view, at least.
And Gerard, that's the story at Bank of America this morning. 15% revenue growth, 8% expense growth. Operating leverage is improving and has been over the past few quarters, Gerard. That's a key goal, I think, for Brian Moynihan and the team. Gerard, are you expecting to see more of the same?
Absolutely. That is a key goal for Brian and his team at Bank of America. It is positive operating leverage. They've been consistently delivering on that, and their focus going forward will be to continue to do that, as with many other banks. So we anticipate to see positive operating leverage throughout this quarter, and certainly Bank of America delivered on that today.
From here, we've got the pure capital markets play, Gerard. We'll be talking about Goldman Sachs in about 30 minutes or so. Tomorrow, another pure play, the likes of Morgan Stanley. Execution, this is something that Lisa was talking about. Environment's great, but let's talk about execution. What's the difference between a Morgan Stanley and a Goldman Sachs right now, Gerard?
The difference between the two, Jonathan, is primarily the wealth management businesses at Morgan Stanley may give it more stability and revenue growth through the full cycle. Goldman Sachs is not there yet. That's one of their priorities, is to build out their wealth management revenues, and they're working on that now. So that's the primary difference between the two. They are both premier investment banks and trading firms, but wealth management really stands out for Morgan Stanley as the differentiating factor between them and Goldman Sachs.
Gerard, it's early days. We haven't gotten Goldman Sachs. We haven't gotten Morgan Stanley. But so far, who's winning earnings?
I would say today, when you look at the numbers across the board, they were all very good. The JPMorgan numbers were quite extraordinary. So if you had to rank them, probably JPMorgan, Bank of America, Wells, but they're all good. So I don't know if you could get 3 gold medals, but so far they're all good.
Gerard, it's good to see you. Thank you, buddy. Gerard Cassidy there of RBC. Let's just stay on that board and look at the pre-market price action right now. The likes of JPMorgan trading a bit softer following the numbers. You saw a decent pop for Bank of America. That name is up by close to 2%. Wells Fargo doing nicely as well, up by 1.5. Going through these numbers, where do you want to be? You want to be in equity sales and trading, don't you?
Obviously.
After a quarter like that.
I mean,
right?
You're just going to get paid. That's your compensation increase. That comes from those equity traders that absolutely knocked it out of the park.
Those numbers are wild.
They're bonkers.
They're crazy, right?
It gives you a sense of how well Wall Street is doing and how much you're seeing some of these IPO shares prices and some of the volatility really underpinning some of these results. On the Main Street side, I know we're kind of glossing over Wells Fargo, which, as Eric Najarian was saying, has sort of been left for dead. But the commentary from the CEO is really interesting. Consumer spending is higher, charge-offs and delinquencies are lower, and savings and investments are growing. Going on to say concerns around affordability and inflation exist, but the labor market and wage growth remain strong. So we're getting the read on Wall Street from a lot of these banks. Heading to CPI and then Kevin Warsh. What's going on Main Street? Well, the read there is pretty positive as well. And that, I think, will have a longer storyline throughout the day.
This is part of the conversation, Lisa. I'm right there with you. The next phase of the bank's trade, it's been about the pure capital markets play amongst the big players on Wall Street. Do you get something that shifts back towards Main Street in the months to come? Bank of America up by, let's call it 0.75% this morning. JPMorgan trading softer. It's down by 2%. Coming up next, we'll catch up with Venu Krishna of Barclays. We'll speak to Henrietta Treyz of Veda Partners. Chris Marinac of Brean Capital joining us to break down the latest numbers from the big banks. And we'll catch up with the former New York Fed President Bill Dudley. Looking forward to catching up with Bill following some very, very punchy comments from Governor Waller ahead of the Fed's next meeting, putting a lot of weight on the importance of the next read on inflation. CPI dropping at 8:30 Eastern Time. From New York City this morning, good morning. The second hour of Bloomberg Surveillance up next.
I really don't see a case for hikes anywhere.
I don't think there is a strong argument right now among Fed officials for cutting rates.
Now, frankly, the U.S. has too much inflation and everybody can see it.
From an inflation perspective, there are definitely some tailwinds and there's some headwinds.
We have a problem if the CPI number's hot.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. The bank story, so far so good. Equities negative by 0.1% on the Nasdaq. Tech bounces back up by 0.5. New numbers on the bond board. Twos very close to 430. Tens through 460. 30s of 5.1% going into CPI later this morning. In focus following this move, in crude. WTI and Brent this morning higher across the board, higher by close to 5% on Brent and closing back in on 87.30 so far this morning. CPI 90 minutes away. Before we get there, numbers from Goldman Sachs rounding out quite a quarter, with Goldman Sachs and Citi on deck in the next 60 minutes or so. This is what we've seen so far. JPMorgan, according to Jamie Dimon, the CEO, a record in every single business line, a record for revenue. We saw more records over at Bank of America, and the trade, the stocks are a little softer off the back of this. They met a very, very high bar.
Yeah, and this is a question of who's expensive heading into this and where are the opportunities. And you could see that in the price action. Wells Fargo had been beaten up, and you'd seen JPMorgan lag behind just because the price to book had been so high. Bank of America with a similar type of trend. When you take a look at the actual earnings, though, in the rhetoric, this is Wall Street going gangbusters with respect to the IPOs, with respect to equity trading and sales and revenues. This is also Main Street doing incredibly well with charge-offs diminishing. And the sense, I keep going back to this Wells Fargo commentary, consumer spending is higher, charge-offs and delinquencies are lower, and savings and investment are growing. Even in the face of headwinds, the consumer continues to come up from behind alongside an absolutely red-hot capital market.
So how well priced are we for this story? And that's the earnings risk coming into quarterly earnings season. The bar was high. How much do you need to beat it by to squeeze out a little bit more of a rally in the stock? Bring up the board again and look at JPMorgan and Bank of America. Big upside surprises across several business lines there, including over at JPMorgan with this on the equity sales and trading revenue side of things. $6 billion against an estimate of just below 4 is a major upside surprise, and yet we trade softer. Look, I know it's early days, and I don't know where the stock will be in 5 minutes from now, never mind by the close, by later on this afternoon. But this will be a question for many people going through earnings season. We always say it on this program. You can learn something from the data. You can learn something more from how the market responds to it, and that's going to be a key test for the next few months.
If this market was perfectly priced, these earnings were even more perfectly delivered, and yet that still wasn't enough. Does that give you a sense of how perfectly priced everything else is, or is this a specific story where people are unpacking expenses or any kind of excuse to sell? If that is your biggest excuse to sell the shares, then ultimately you are looking for a reason to buy on the rumor and sell on the news. Is this perhaps the foreshadowing for the rest of earnings season?
This is the early move. We'll see if it sticks, but JPMorgan's trading softer by more than 2% this morning. Want to turn back to crude. Got a big move on Brent, up by close to 5%, $87 a barrel on Brent crude. WTI through $80 a barrel a little bit earlier on this morning, and it holds at 81. The tension in the Middle East unresolved, and another potentially unworkable suggestion coming from the White House.
Not just unresolved, but you see actually more escalation overnight. You see the Iranians go after UAE vessels. You see the Houthis actually strike a Saudi airport. And the President of the United States saying the blockade is coming back on. That will go into effect today. And at the same time, even though they took issue, clearly, with the Iranians trying to charge a toll to go through the Strait of Hormuz safely, now this administration is demanding a 20% reimbursement for what they say is protecting all this cargo. But you keep bringing up the great point. They haven't really been able to demonstrate they can protect every vessel because we are at this point. If you go through the U.S. protected route that hugs the Omani coast, well, you're a target of the IRGC.
That's the latest out of the Middle East. That's a wrinkle for this market story. Here's another one. This from IBM just moments ago. We were looking at the banks earlier, just a few moments ago, and we were talking about beating but not beating by enough to generate a rally. This is not the quarter where you want to miss. Second quarter revenue, $17.2 billion. The estimate, $17.86. The stock plunging. Lisa, by close to 15%.
Yeah, the IBM CEO coming out and saying what played out was worse than our expectations, saying this was an execution problem, saying in the last few weeks of June, we saw clients shift their quarterly CapEx spend towards servers, storage, and memory purchases to secure supply-constrained infrastructure ahead of expected price increases. So this is the hoarding that we were talking about. This dynamic impacted client buying powers. While we anticipated some supply chain-related impact in our expectations, we did not anticipate the magnitude of what actually happened. And this ultimately is what happened, that CapEx differential of where people were spending. Again, it just highlights how quickly moving this is and how much people are underappreciating the speed in which the tech story really is shifting.
Numerous large deals failed to close on time. That stock is down by close to 15%. Coming up this hour, we'll catch up with Venu, Krishna of Barclays, heading into an action-packed day on Wall Street. We'll speak to Henrietta, Treyz of Veda Partners following a renewed blockade on the Strait of Hormuz. And we'll catch up with the former New York Fed President, Bill Dudley, with Kevin Warsh heading to Capitol Hill. We begin this hour with stocks eyeing a rebound as the big banks meet the high revenue bar set by Wall Street. Venu, Krishna of Barclays writing, we remain constructive on equities and would view any near-term positioning unwind as a buying opportunity. Venu joins us now for more. Venu, good morning.
Good morning.
It's good to see you. Let's talk about how high that bar is for this earnings season based on the evidence so far this morning.
If you saw our recent upgrade of our price target, we're seeing this upside, but the upside is limited because we've had the bunch of the upside already realized. And unfortunately, now we've entered a new regime where the macro risks have escalated. Oil is up, interest rate uncertainty is already there, so that is also going the wrong direction. Inflation is sticky, that's a problem. And within the AI narrative, there's been a shift. The most crowded trade was out of hyperscalers, out of big tech into semis. Now that's also being tested. So I think overall, though, if I think about why we are optimistic about equities, it is simply the power of earnings is too strong for the next, call it 18 months, because we do have visibility on that capital spending, because the folks who are spending have the earnings, the operating cash flows, and access to liquidity between credit, equity, and convertible bond markets. And that is sustaining a broader ecosystem of earnings.
3 months ago, that story wasn't well understood. Clear evidence for that. We had to price a positive earnings shock in this market really quickly. Earnings expectations kept climbing going into this earnings season. Is that story well understood and well priced now?
I think it is reasonably well priced. If you're seeing what's happening to multiples, they have been steadily declining. And now on top of that, to add a little bit more fuel to the fire on multiples, 10-year rates are back, over 4.6%. And we just about, call it a few weeks ago, we were in the 435, 440 handle. But what I would say is in this earnings season, what you're likely to see is a repeat of what you saw last quarter, which is if companies are beating their numbers, the reaction is muted. But if you miss, it's a punch on the downside. And I think it just tells you that the amount of idiosyncratic risk in the market is tremendous. We have noted on the derivative side that most of the volatility now is squeezed into earnings season. So that concept of earnings drift, where the market absorbs information and stocks eventually react to the earnings information, is pretty much gone. It's all packed into that one particular day and that one particular event. So this is a highly sort of dispersion-driven sort of market, where correlations are at historic lows, return dispersions are at historic highs, which means that this is an idiosyncratic market.
This is a forward pricing market. They're trying to look into the future and gauge exactly how much these earnings can continue. We've been talking about all morning how it's very difficult to get a read of how hot the capital markets will remain for the rest of the year. The IBM story really highlights how quickly this is shifting. It seems like underpinning this are the hints of Mythos and some of the concerns that came out with Fable and some of the other innovations that concerned cybersecurity experts in a dramatic fashion. How much can you get forward visibility from any of these companies when the C-suite tells you they have no idea where it's going, how fast it's moving, and how quickly their businesses are shifting?
I think your point is well taken, and that is consistent with the fact that we've entered this whole disruption phase of the AI story, where there'll be winners and losers, and we don't know which business models are adopting well and which are the new AI native businesses. If you look at the IBM number, from what I understood, based on what you just reported, the miss was marginal, right? But it's just that the expectations are so high and the market is just punishing even marginal misses. That's what we have seen. But going back to a question of how much, we do have visibility. And that visibility is being driven by the dollar amount of capital spending. And that capital spending is funded, and which means all the beneficiaries of dollars are doing well. So what you need to care about is, are you overpaying on the beneficiary side? And are you underpaying for the strength of earning stability for the guys who are spending, who are still posting well over 30% earnings growth? And so that is a setup. And that's why, we are still broadly constructive in technology. But you have to recognize, like I said, that this is a very, very idiosyncratic market. So this is not about making a tech call, but about mini and micro themes and individual stocks making, is the way to go.
Putting aside IBM for a second and just looking at the bank earnings, what's the argument, just looking at those, for a Federal Reserve not to hike interest rates?
It's a tough one. The biggest argument is that this inflation we are seeing is going to eventually start tapering off, by early part of next year, which seems to be at least certainly even our house call. But the problem is that if inflation remains sticky and if these Middle Eastern crisis again crops up and goes the wrong direction, and by the way, if it does, that is breaking the tradition of the last 3 decades of geopolitical risk, where generally speaking, it's been geographically contained and or it's been resolved in a reasonable period of time. Not so it appears in this situation. So I think rates market already showing that uncertainty. Like I said, 10 years are up almost 25 basis points just in the last few weeks. And the higher the head, and I've said in the past, 5% is a critical threshold for equities. There's a very clear negative correlation empirically over a long period of time between 10-year rates going up and equities going down. And I think we're seeing that in multiples moderating. So it's not just rates and increased macro risk, but it's also the fact that the AI narrative has made people uncomfortable because the sheer amount of dollars spent is enormous. And so the market is sort of waiting to, that's why, and saying that the folks are spending, even though they have earnings, we don't know what the returns are going to be. We don't know if this is going to be a permanently capital-intensive business or how long this continues. There's no line of sight on that. But we might as well benefit the players who are getting those dollars. But that is also, again, being tested now.
Venu, it's good to see you. It always is. It's a real test for this market this morning. Venu Krishna of Barclays. This is not the quarter where you want to miss. Captured by IBM this morning, trading lower by more than 17% in the pre-market. Let's bring up the stock and then look at how this bleeds across the sector. IBM is down 17. This is sparking a rout across software. SAP over in Europe. ServiceNow here in the United States. Those names all struggling, Bramo, off the back of this.
Yeah, because it wasn't just a question of IBM not exactly executing in certain ways. This was an overall read on a distracted business sector that was trying to plug any demands from cybersecurity. Again, we talked about Mythos. We talked about concerns as that was shut down by the U.S. government on behalf of a lot of companies that said, hold on a second, we've got a lot of holes that we're finding and we could be really vulnerable. Also, a question of hoarding. How much are people trying to get ahead of the price increases from the chip sector and avoiding the software side of things? Again, is this a read on the SaaScopolis or is this a read on the prioritization of hardware ahead of whatever is to come?
IBM, a miss on revenue. The stock is getting hammered in the pre-market. Let's get you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Well, even beating doesn't guarantee you a bump these days. Bank of America and JPMorgan both lower in the pre-market, but both reported second quarter results that beat Wall Street estimates. BofA results led by a surge in equities trading and also a deal-making resurgence. JPMorgan reported its highest quarterly profit ever, with CEO Jamie Dimon saying revenue in each line of its business hit a new record. He did add several risks are shifting below the surface like tectonic plates. As you were saying, IBM shares tumbling. The company reported preliminary second quarter results that missed street estimates. IBM CEO Krishna saying clients were distracted by cybersecurity concerns and numerous large deals failed to close on time. In sports, France and Spain face off in the first of 2 World Cup semi-finals at 3 p.m. Eastern in Arlington, Texas. Tomorrow, Argentina plays England in Atlanta. The winners of each game will face off in Sunday's final in East Rutherford, New Jersey. And that is your Bloomberg Brief. John.
Vonnie, thank you. Thank you for the update. More from Vonnie later this morning. Up next on the programme, reinstating the blockade.
We're putting the blockade back. We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up discontrolling the whole thing.
Henrietta Treyz of Veda Partners joins us next, live from New York City this morning. Good morning. Equities, futures, doing not much at all. It looks like a snooze. Equity futures down by about 1/10. On the S&P, on the Nasdaq, up by 0.5, away from the index. This is anything but a snooze this morning. Check out the banks first. Record numbers over at JPMorgan across every business line, according to Jamie Dimon. on revenue. The stock is down 2.5%. Bank of America, a record for sales and trading revenue. The stock is up by not even 0.1%. Beats this morning are not being rewarded. Misses are being absolutely punished and some. Check out IBM. IBM with a miss. The stock is down by close to 18%. And that miss on IBM sparking this move on other software names. You can see it across Microsoft, ServiceNow, others. Microsoft this morning down by 3 or 4 percentage points, Bramo, the last time I looked. Pretty ugly stuff.
Yeah, a real question around what software names are going to do given the shifting priorities and the rapidly shifting priorities away from software, unless it's related to security, and potentially toward the hardware, because that is where the focus was. IBM CEO talking about the inability to close some large deals, in part because people were front-loading purchases of memory chips and other software. And again, you keep wondering how disruptive is the likes of Mythos, of Fable, to really reignite a race into cybersecurity.
We're just 5 minutes into this, so I don't want to make too much of it. Things can change as the earnings season grows a little bit older, but the early takeaway, and we'll see if it's premature, but the early takeaway is this bar was very high. Beating it's not enough. You've got to absolutely smash expectations and some to generate a stock move. Based on what we've seen so far this morning, that can change. I'm open to that changing. But so far, what we've seen this morning, you miss, you get battered, you beat, you don't get rewarded.
If people get a sense that there is any weakness, there is an existential fear hovering over a lot of these earnings at a time of rapid shift. And I just wonder how much forward guidance we're actually going to get from any of these banks, let alone other companies, given the lack of visibility into the pace of change.
Goldman Sachs, the next bank, set to report in the next 10 minutes or so. We'll get to that. I need to talk about this as well. We do. Crude up 4% on Brent. $87 a barrel this morning. Under surveillance this morning, reinstating the blockade.
We're taking out all of their capability for anything having to do with the Strait, with the Hormuz Strait. And I think in the end, we will end up just controlling the whole thing. We're controlling the Straits. We're putting the blockade back. I want to be reimbursed because we're protecting a very rich portion of the world.
So here's the latest this morning. The president declaring the U.S. the guardian of the Strait of Hormuz, reimposing a naval blockade on Iranian ships and proposing a 20% fee for all other cargo shipped through the passageway. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, these moves threaten to escalate tensions further and, of course, change the economics of shipping energy through the Strait. We haven't gotten further details from the White House on the president's proposal for this 20% reimbursement, though it could mean that some of the largest oil tankers would be on the hook for paying more than $30 million per trip. The administration isn't calling this a toll. They're calling it a reimbursement, though I will point out that back in April, when Iran was really pushing the idea of a toll, the Wall Street Journal did an analysis that found that Gulf states would be on the hook for paying nearly 80 to 95% of the total costs. It's unclear at this point if the Trump administration has been in touch with regional allies about the idea, as they are taking the brunt of Iran's retaliation. Overnight, the UAE's defense ministry confirmed that 2 of the country's tankers were hit by Iranian cruise missiles amid the latest wave of attacks by the U.S. designed to degrade Iran's ability to attack commercial shipping. And John, we're not just watching for reaction in the region. New this morning, we're hearing from China urging a reopening of the Strait of Hormuz. China's foreign ministry saying that they are, quote, deeply concerned ahead of the U.S. moving forward with this blockade today at 4 p.m. Eastern.
Tyler Kendall with the latest. Tyler, thank you. To build on this, Henrietta Treyz of Veda Partners writing, the president's newly proposed 20% reimbursement fee he intends to charge and the renewal of the blockade of the Strait of Hormuz creates far more questions than the White House has answers for. Henrietta joins us now for more. Henrietta, welcome to the show. What's your number one question this morning?
Well, I think the reimbursement fee is more of a distraction. So my real question is, how exactly do you plan to get flow through the Straits again? We need the EU and the UK involved in anti-mining efforts. We obviously have a renewed escalation on the military front. What is the objective and the goal here? And you and I have talked for months now about how the Ayatollah, in my opinion, is the most important dynamic in this entire war. We know what the nuclear file is going to look like. The president gave away the ballistic missile component. What we really need to resolve is this idea of taxation of the Strait. Tax policy is extraordinarily complicated. It impacts every single Western corporation and country, whether you're an insurer or a bank or a tanker. You're going to have to deal with the IRGC, and that is just unsustainable. So I don't really care what the president is talking about on the reimbursement fee side here in the United States. I don't think that will hold. The margins are too high in terms of what he's asking for. I think it really needs to be resolved how Iran is going to be kept off of its idea of a port authority.
When it comes, though, to the Strait of Hormuz, and you think potentially this 20% reimbursement is a distraction, is it maybe a carrot and stick to try to get the Europeans and NATO to actually go support the United States in the Strait of Hormuz and defend it?
Yeah, absolutely, Annmarie. That's what they were talking about at NATO in Turkey. The idea that specifically France and the UK need to get in there and help with the anti-mining components is something that I've heard from military brass since the war started, and their abilities, their capabilities, and their desire to get a larger conglomerate of NATO allies in there with them. So not just the two nations, but maybe 20, 30 different nations to have a real sizable component. Now, what they have said in the past is we need some sort of permanent ceasefire that we can really trust before we'll send huge swaths of our military in to help the United States with this region and to secure peace. We're not there. We do not have peacetime. We do not have a ceasefire, even a tenuous one. It is full-scale military engagement now, as the last 3 days or so of bombings indicate.
Will Republicans in Congress support this?
I would say the better way to say that is that they won't oppose it. So there will be renewed fights about how to give the president war powers and whether or not we should strip them back. That's what Democrats and Republicans in the Senate have voted on several times, and it's passed. And you've seen that the president has a real problem with the Republicans who cross the aisle and vote to rein in his war powers. That was with Senator Senator Cassidy and Senator Rand Paul just a few weeks ago. The president wants them not to get in the way. And so far, the senators have been accommodating. They're going to be distracted with the third reconciliation effort. And I think that will keep them off of major opposition to the president's war.
Just very quickly, who fills the Lindsey Graham void that did a lot of this fixing?
It's going to need to be a lot of people. I mean, his reach is across the Budget Committee, about this across the State and Foreign Operations Appropriations Committee, Judiciary. Should we get any kind of new nominations to the Supreme Court, you're going to have a lot of people step in to fill his shoes.
Henrietta, it's good to see you, as always. Henrietta Treyz there of Veda Partners on the latest as we wrap up that conversation. Goldman drops. Fixed sales and trading revenue, $4.59 billion. The estimate, $3.76. That's where all the revenue went in FIC then. Second quarter equity sales and trading revenue came in at $7.42 billion. The estimate was $5 billion. I'll go through that number again, OK? $7.42 billion for equity sales and trading revenue. The estimate was just north of 5. That's another monster upside surprise.
They knocked it out of the park in pretty much every capacity that you could possibly imagine. The idea that you could see equities revenue coming in more than $2 billion, $2.4 billion beat. I think it's interesting when you take a look at some of the commentary coming from Goldman Sachs CEO, that you can see he sees this continuing. We expect this flywheel of activity to continue. Look for the forward look, because that ultimately will give you the true guide.
You need to smash it this morning. Goldman just did. The stock is up by 2.4%. Chris Marinac of Brean Capital joins us next. Goldman, just reporting earnings. Check out the stock. The stock is up by just 0.9% after absolutely smashing estimates, which seems to be the story so far this morning. That beats are not being rewarded and misses are being punished. And we'll get into that in just a moment. But let's start with Goldman. Second quarter equity sales and trading revenue, $7.42 billion. The estimate was $5.02 billion. That is not just a record for Goldman. That is a Wall Street record. Goldman Sachs FIC sales and trading revenue, $4.59 billion. The estimate, $3.76. Wherever you look, you're seeing some major upside surprises.
Yeah, the firm's second quarter results are the third consecutive quarter in which the firm's equities unit has set an all-time record for any bank. Just to put this into perspective, I mean, this has been a bonanza for now 3 consecutive quarters. The magnitude of the beats is pretty notable, which is the reason why, even in the face of a skeptical market that is punishing other names for beating, they are rewarding this name. That is how big of a surprise this actually is.
And that's the reward, Bramo, 2%. Right, isn't that the story? Like, you get 2%. For smashing estimates, you'll get a 2% rally. And let's see if it holds. But that's what you're getting so far. Over at IBM, and we'll talk about that a little bit later, you miss, you get absolutely hammered. You lose a fifth of your value if you're a tech stock right now. That's a massive problem.
This is a market that has such high expectations and is so skeptical of getting beat that even incredible earnings from Goldman Sachs, but also the promise of more to come. I mean, again, you're asking the question. We've been asking the question all morning. What about the forward look? How long can this last? Is this as good as it gets? What we're seeing from Goldman Sachs, the chief executive officer, David Solomon, given what we see in our pipelines, we expect this flywheel of activity to continue. In other words, saying that there is more runway here. Nonetheless, you still see that skepticism percolating other places.
The capital markets business has been absolutely flying. The business has been doing tremendously well. It's why the likes of Goldman and Morgan Stanley have been rallying so hard. That's the latest on the banks this morning. Let's get to the others, including IBM. That stock is down by 19%. With more, with your morning move, Yahira has that. Hey, Yahira.
Hi, John. We start with the big banks delivering blockbuster results, but that is not enough after a rally that's pushed many of those to record highs. JPMorgan, you just went through Goldman's numbers, which were astonishing, record-breaking. JPMorgan also posted a record $6 billion in equities trading. Bank of America and Wells Fargo also benefited from stronger trading and investment banking, underscoring how busy it's been for Wall Street with deal making and equity issuance on pace for the strongest performance in recent years. Turning to bank earnings, also highlighting, as I said, how strong capital markets have been, and that is seen through SK Hynix. Of course, it had the largest equity sale by a foreign company in U.S. history. Its shares bouncing back this morning, up nearly 7% after falling 9% yesterday. And we end on IBM, the name that we've all been looking at, down nearly 20% in the pre-market. The company says customers shifted spending late in the quarter, pulling money away from software as they prioritize the AI build-out, spending more on those pricey servers and memory needed to power it. That adds to concerns in the software sector, which had already been struggling over concerns about relevance in the AI age. And now this just adds to another worry for software. John?
Yahira, thank you. Thanks for the update. That right there, that stock, that's a big warning to the tech story for the next month or so. You miss. Do not miss this quarter.
And
it
wasn't a huge miss. I mean, again, this is really, we're talking about less than $1 billion and 17-some billion dollars of revenue. That was still enough to torpedo the name, at least in pre-market trading and the entire sector, because of the existential fear of how quickly this market is moving. And I think that that is the underpinning here. The idea that all of the spend could go away from software to hardware in one quarter and avoid really consolidating deals. Again, it just shows what potentially could be the risk.
I think by some measure, Goldman's beat on equity sales and trading revenue was larger than the miss over at IBM.
Oh, significantly more.
Right?
Oh, yeah, it was less than $1 billion in terms of the miss at IBM, and the beat over at Goldman Sachs on just the equities trading was almost $2.5 billion. So it gives you a sense of what we're talking about here.
Goldman Sachs this morning up by 2% in the pre-market. Let's turn back to the big banks. 5 of them reporting second quarter results this morning. Goldman, the latest cross in the wire. Chris Marinac of Brean Capital joins us now for more. Chris, you've had a few moments to gather your thoughts on this one. What's your reaction to these record numbers out of Goldman Sachs?
Well, John, I think there's more to continue. I wouldn't be surprised if we have another really good quarter in Q3. And I think as the point was made in the release, the runway is still very good for additional earnings. And I think that applies to other banks besides Goldman.
How well priced do you think we are for that story, based on the reaction we've seen to the numbers so far this morning?
So I think the marketplace may temporarily sell the news, but I still think people will come back to these stocks. They're not expensive on 27 earnings, and I think the attitude towards 27 should be more bullish, and I think estimates can rise for next year. Plus, I think the second half of this year will still be quite good. So I think estimate increases are going to drag stocks higher.
At a certain point, though, Chris, do you think that expenses are going to sort of be the weight on these names? We see that as the excuse being used for the JPMorgan share decline so far this morning.
I think credit costs are a piece of the expense puzzle. So if you look at overhead, you're correct. But I also think if you think about credit costs, they actually beat on provision expense and charge-offs. And I think that credit theme being positive is a huge factor in favor of these companies.
If you think that there's more to come, and that certainly seems to be what David Solomon is indicating in his commentary in the letter ahead of earnings, what is the argument here for the economy slowing down and, frankly, for the Fed not to hike rates?
Well, I think the banks are taking share, number one. I also think the way the curve is acting favors the way banks are positioned. There still is a refinancing of loans for many mid-sized companies from 2022 and 21 that is going to benefit net interest income and margin the second half of the year. I still think overall volumes are going to be consistently good. And then you layer in the operating leverage in the space plus low credit costs, that continues to factor into very good earnings. And then let's not forget the capital build that is in the space. And ultimately, that's going to lead to more buybacks and I think greater investor confidence, which gets back to the PE expanding.
This is the kind of economic activity that these banks can leverage. This is the kind of capital markets activity that these banks love. And Chris, we've seen that through the pure plays, the likes of Morgan Stanley, the likes of Goldman Sachs. Those stocks have been absolutely flying. Chris, let's talk about is an area of this market that you know well. It's the regionals. The regionals are up by close to 18% so far year to date. That's outperformed many a big bank on Wall Street, with the exception of Morgan Stanley and Goldman Sachs. Chris, what's providing the regionals with this kind of tailwind right now? And away from capital markets and that business, is that set to continue?
I think it is because there's regulatory relief, John, and I think ultimately the way that the Fed and OCC has teed up the industry, there is a window for expansion in the space. I think you will see more M&A. I also think the companies themselves are getting this capital relief and I think a better regulatory attitude that ultimately leads to better earnings, a little bit less regulatory spend than what they were spending a few years ago. And ultimately, it weaves back into higher confidence about the earnings.
So, Chris, when we see these consumer sentiment numbers and they are rock bottom, they are absolutely awful. And I understand why. I respect it. The accumulation of problems when it comes to prices and inflation. And we'll see CPI again in the next hour or so. Are you saying that you're seeing activity that corresponds with a pickup in loan demand across small and medium-sized businesses, consumer demand as well, that's going to provide gains for these guys?
Yes, and I think historically, if you go back to the 80s, John, when we had early 80s inflation, the banking system had more credit and expansion of credit was definitely a theme. You can go back to the old Berkshire Hathaway annual reports to confirm that. I do think you're going to see better credit demand. The Fed H8 data has been rising in recent weeks. So I think this quarter is a trigger point towards a higher second half on loans.
Chris, you keep saying that this is a good regulatory environment, a really good one. And I wonder, when you say gaining share, if the banking sector is winning back business from private asset management firms that had been eating their lunch.
Yes, I think that's true. And I think we see a little bit this quarter, and I think we'll see a lot more of it the next 3 to 4 quarters.
Which bank do you think is poised to benefit the most from that share consolidation?
Well, certainly the regional banks who have lost a little bit of business and have been trying to fight back. So that goes back to Fifth Third. It also goes back to PNC and Truist, those who are still reporting as the week goes on. But I think to some extent the national players at B of A and JPM should benefit, and Wells as well. So I don't think it's just related to the regionals. I think it is a large cap bank, systemic benefit.
Is the read here that ultimately the economy isn't just solid, but that it seems to be reaccelerating? And I say this based on the fact that loan loss provisions have come down, that there is the expectation for this to continue even in the face of inflation and rates that potentially are going to stay where they are or go higher?
I think that's true. And I think there's a lot of regular way activity that the banks see. So we've talked so much about AI in recent quarters that the non-AI spend is still there. It may not be as big, but it is still positive. And I think the banks are picking up more of that. I also think there's been less distractions this year because you haven't had any problems in the banking system to kind of distract investors. That's part of my thesis, that you could see earnings get better, demand better, and also multiples expand on the 27 estimates.
Hey, Chris, it's good to see you. I know you're going to stick around. Stay close because we'll get Citi in the next 20 minutes or so. Chris Marinac there of Brean Capital. Check out Goldman. Let's bring it up. Look at the stock move. So they've just smashed estimates this morning. Knocked it out of the park when it comes to equity sales and trading revenue. And that stock is up by just 1.4%. Call it 2% higher so far this morning. If you're looking at Goldman on the year at the moment, higher by 20% year to date. Morgan Stanley up by 24, call it 25% higher. The market was anticipating a lot of this. Where there's pushback right now, the bar is high. And if you beat, you don't get a massive reward. But if you miss, you get obliterated. That's the story of the last 60 minutes.
Yeah, particularly when it comes to tech. And ultimately, the banking story is one of an entire market that is really performing well. On the flip side, there are some real fundamental questions about shifts under the tech sector, which we keep talking about with IBM. But with Goldman Sachs, watch this space, especially for the commentary. How much do other banks reflect that commentary? Also, what Chris was just saying there, these banks are all winning back market share from the asset managers like Apollo and KKR and others that have eaten their lunch over the past few years because the regulatory environment has gotten more favorable to them. How much will that be their gain at someone else's pain versus an entire market that is just heading in one direction?
Regionals have had a nice run. We talked about it, up by close to 20% so far year to date. Let's get you a wrap-up of all the news right now. Let's get to your Bloomberg brief with Vonnie Quinn. Hey, Vonnie.
Hey, John, thank you. The White House saying President Donald Trump will support one of Senator Lindsey Graham's last major legislative efforts before he died, a new sanctions bill on Russia. The bill would impose so-called secondary tariffs as high as 500% on countries that bought Russian oil or natural gas. Chinese AI startup DeepSeek is considering a fresh round of fundraising. The Financial Times reporting the company is in talks with investors for a round that would value it at $71 billion. DeepSeek completed its first funding round at the end of May. And recapping this morning's big bank earnings, Goldman Sachs beating its own stock trading record, posting a $7.4 billion haul for the second quarter. JPMorgan also reporting its highest quarterly profit on record. And Bank of America seeing a surge in equities trading and a major pickup in deal making. That is your Bloomberg brief. John.
Phenomenal numbers. Vonnie, thank you. When it comes to equity sales and trading numbers, we're talking about a pickup of 70% plus at Bank of America and Goldman Sachs compared to last year. Tremendous spike.
I believe it's more than 80% over at JPMorgan in terms of the gain quarter over quarter, year over year. So it just gives you a sense of the momentum. The fact that you can get record after record after record. Again, how long can this last? It seems like just a little bit longer.
Jane Fraser in City, over to you. 20 minutes away. Up next on the programme, the case for hiking rates.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term.
Governor Waller getting people talking about a live meeting in a few weeks' time. We'll catch up with the former New York Fed President Bill Dudley. He joins us next. Down a tenth, go back to bed. Switch off the alarm. Nothing's happening here. Equity futures right now down by 0.1% on the S&P. On the Nasdaq up by 0.5. That's not the story at the index level. The single name and sector level story is really quite remarkable so far today. It's an early test for earnings season, a very early test, but it's a test nevertheless. Check out the banks. Banks knocking it out of the park this morning. Goldman crushing estimates. Goldman's only up by 1%. JP's down by 2%. Bank of America's down by 1.7%. JPMorgan, as they pointed out this morning, record revenue across every single unit, business line, according to the JPMorgan boss, Jamie Dimon. I got a message from a Bloomberg subscriber just moments ago. If this is the reward for that Goldman number, tells you a lot about market positioning right now. Goldman Sachs only up by 1.3%.
Yeah, this is redefining the idea of price to perfection as something that is so perfect that we could hardly imagine it because the expectations out there truly were shattered, particularly by Goldman Sachs and the shares not moving that significantly. How much does this speak to a general mood right now where people are just generally skeptical versus something that will actually last? Ultimately, we have to check at the end of the day to see exactly how people read this. The early read, though, gives you a sense that maybe people were waiting for the earnings season to sell the news.
It's the first few pages of the first chapter of earnings season, but this is the headline so far. This is the story. If you beat, you don't get rewarded. If you miss, you get hammered. IBM with a miss and down by 24%. If you miss, you can lose a quarter of your value in the pre-market just like that. IBM down 24. It bleeds through software. Microsoft down by 3.
Yeah, the potential here for a broader market impact, given the fact that software really was not the area that people were spending on. That was what IBM highlighted, that it really was hardware. In other words, Semi's gain has been everybody else's pain in the tech stack. And that seems to be the story from IBM. How much this really speaks to, again, what could be ahead for any other tech companies that miss earnings, even by $600 million, gives you a sense of what's at stake here.
IBM down by 24% so far this morning. That's the equity picture. The bond market story. Yields coming in. Money going back into fixed income this morning. 2s back to 426. 10s around 460. Yields pushing higher in the last 24 hours following a very hawkish speech from Governor Waller. Under surveillance this morning, the case for hiking rates.
If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. As always, we need to avoid making the mistake of fighting the last war and reacting too soon to tighten inflation.
So here's the latest this morning. Traders boosting bets. The Federal Reserve will raise rates later this month. Investors awaiting fresh inflation data. And Fed Chair Kevin Warsh's testimony on Capitol Hill a little bit later this morning. The former New York Fed President, Bill Dudley, joins us now for more. Bill, what was your reaction to that? And welcome to the show, buddy. What was your reaction to that speech yesterday? And what is the likelihood that this meeting this month is indeed live?
Well, I think it is live because inflation's been above the Fed's target for over 5 years. And the core inflation has stayed quite sticky over the last few months. Waller basically is providing the guidance to the market about how the Fed's likely to react if the inflation news is bad that Kevin Warsh has been unwilling to provide. This is one of the problems that Kevin Warsh, I think, has. If he continues to be as silent as he has been about how the Fed is likely to react, his voice is just going to be replaced by other people that are going to provide more insight into terms of how the Fed is likely to react. I think there's a strong case for tightening monetary policy. I don't see much evidence that monetary policy is actually restrictive right now. Financial conditions are extremely accommodative, and that's providing quite a strong impulse to the economy. And then you have the AI investment spending boom, which is likely to continue for a while longer. Both those things, to me, argue for the Fed to raise rates. The Fed isn't there yet. I don't think Kevin Warsh is there yet. If you look at what he said in his public remarks, pretty optimistic about AI, helping you on productivity, holding down inflation. But Waller, has put a marker down. And I think there's a lot of other people in the Fed that feel the same way.
Bill, do you think that's where we can find some common ground? There are some people that do think we are slightly restrictive. Many on the FOMC do not share that view. But can we find consensus around the following idea that we aren't sufficiently restrictive to get inflation back to target? Is that where we can find some consensus on the committee?
I don't think there's much evidence of that. We've been in this supposedly restrictive setting for several years now, and inflation hasn't come down, and the economy and the unemployment rate hasn't gone up. So it seems to me that the evidence that monetary policy is exerting restraint is really quite weak in the current venue.
Bill, we've been just getting bank earnings, and frankly, it seems like all cylinders are firing as quickly as they possibly can, record after record after record in capital markets, as well as Main Street activity that seems to be reaccelerating. By not hiking interest rates, do you think that this Fed is allowing some sort of capital markets bubble, effervescence, whatever you want to call it, to build?
Well, William McKee Martin used to say that the Fed's job is to take away the punch bowl when the party just starts getting good. And I would say the party is getting really good right now. So this is the flip side of financial conditions being very accommodative. And so I think that argues for the Fed raising rates a little bit. The CPI will get a good headline CPI this month. But that's not going to have as much weight now that the war in Iran has started back up and energy prices are headed back up. So it's really what's happening to inflation beyond energy prices that's really going to matter. And I think that's what Waller flagged this past week.
There's a question about the idea of outsourcing some of the commentary to other Fed officials on the part of Kevin Warsh, with Chris Waller really sucking up the oxygen in the room. Do you think that this is actually a desirable outcome, or do you expect Fed Chair Warsh to clip the wings, say, of a Chris Waller?
I don't think that the Fed chair has a lot of power to limit the ability of people to talk about their outlook for monetary policy. I mean, that's what Fed officials do. That's their job, is to conduct monetary policy. So I think the problem that Kevin Warsh might have is that as people like people like Chris Waller speak up, and Warsh does not provide similar kind of guidance about what his monetary policy reaction function is, it basically makes him less important and makes people like Chris Waller more important in terms of guiding markets.
So, Bill, what does he say today? His first testimony as the Fed chair before Congress on the heels of not just what Governor Waller said, but also CPI. Does he just stick to the script of his task force and I'm not going to provide guidance?
I think it's going to be more of the same. I think he's not going to provide much guidance about where he's going forward. I think where he's done himself a good job, done himself a good service, is basically underscoring the fact that he's committed to the independence of the Fed. So compared to where he was when he was testifying before the Senate Banking Committee for his confirmation, he's gotten a lot more distance from President Trump. And I think he's really reinforced the idea that he's not going to change the Fed's commitment to price stability.
Bill, picking up your point about financial conditions, they're easy in some sectors, but do you expect Kevin Warsh to double down that they're restrictive when it comes to the housing market?
Well, I think the housing sector is the weakest part of the economy. But the question is, why is housing weak? Is it weak because interest rates are too high? Or is it weak because we're not having any more immigration into the United States? And so the growth rate of the household formation has collapsed. And so with that, the demand for housing is much weaker than it was in the past. You know, when you're creating 2 million jobs a year, that created a lot of demand for housing. When you're not creating much in the way of job creation, the housing demand is going to be a lot weaker. And so I don't think the housing sector is weak so much because rates are too high. I think it's weak because we're not seeing a lot of growth in the labor force.
Bill, well framed. As always, sir, it's good to hear from you. The former New York Fed President, Bill Dudley, going into this testimony, semi-annual testimony from the Fed Chair, Kevin Warsh, later on this morning. To Bill's point, the party getting started. I mean, they've been spiking a punch bowl, haven't they? Well, like David Guetta turned up, played a full set. There's flares in the bottles of champagne.
I was listening to him. I was listening to David Guetta this morning.
June, what a month.
That's your never mind.
That gives you a sense of what we already expect from bank earnings. Look, I think that his point here is to take the punch bowl away, to raise rates a little bit. Is that going to be the view? Because we just removed the easing bias. We had an easing bias since the last meeting.
Baby steps with this committee, right?
This is not exactly one that's ready to wholesale, call the cops.
I said it in the question to Bill, where can you find some common ground? We've got to be able to find some common ground around the idea that we are not sufficiently restricted at this committee. Even if you think we're somewhat restrictive, can you really make the argument that we are sufficiently restrictive to get inflation back to target when you've been above target for this long?
I think that ship has sailed, given the fact that inflation hasn't come down. If you were sufficiently restrictive, then inflation wouldn't be running as hot as it was. And even if we're talking about downside surprise of 3.8% versus the 4.2% on CPI, it still has a 3 handle, really in the wrong direction.
2's at 426. This is a month rolled into a morning. 5 bank earnings, CPI, testimony from the Fed Chair, Kevin Warsh. Citi, earnings from Jane Fraser in about 5 minutes' time. Look out for that. After that, CPI, 8:30 Eastern Time. The next hour of Bloomberg Surveillance. Up next.
Earnings are exploding to the upside.
The market is very excited for this week.
We're all expecting great things.
We don't want to overthink the secular trade.
We're still in a really strong earnings environment for U.S. stocks.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action, the scores look like this. Equity futures on the S&P down by about 0.1%, on the S&P 500. On the Nasdaq, up by 0.5. The index level story, not the story this morning. The headline is an earnings season at the stock and sector level. Bank of America this morning, down by 1.3. JPMorgan, down by 2.7. They were delivering record numbers across equity sales and trading revenue. Goldman Sachs knocked it out of the park, and we only see a bounce of 2%. The headline so far this morning, if you beat, there ain't much of a reward, but if you miss, well, you get absolutely obliterated. IBM this morning with a miss. The stock is down by 23%, and Bramo, that bleeds right through software worldwide.
Yeah, perhaps gives a sense of what's to come given the shift in spending away from software toward hardware, toward cybersecurity. The big banks clearly seeing that even small gains, small beats, not enough to get the job done.
Get another beat, but this is a small one from Citigroup. Second quarter equity sales and trading revenue, 2.3 billion. The estimate 1.9 might sound large, but compared to what we've seen elsewhere, that is a small beat. If you're looking at fixed sales and trading revenue out of Citi this morning, 4.71 billion. The estimate 4.56. That's a nice upside surprise. That won't get it done this morning. Citi in the pre-market down 1%.
Yeah, the bar has been reset for banking stocks. If you don't report some sort of not only a revenue beat, but some sort of 80-70% increase year over year in quarterly equity trading sales, or some sort of astronomical superlative type of quarter, you're not going to attract a lot of those investors. And that just really feeds into what we've seen all morning, which is essentially you have to beat so astronomically high to even have your shares go up in any kind of way. Again, really speaking to that, because ultimately they beat across the board. Markets revenue, $7 billion versus 6.45. Wealth revenue, 3.2 versus 3.07. All of these, beat, just not enough.
It's not a judgment on the quality of the quarter or the execution of the management team and everyone working at, say, the likes of Citi. These are great numbers, and we've seen them elsewhere. This is about how the market is choosing to reward or punish those numbers so far this morning. You mentioned a bunch of numbers there. Net interest income for the second quarter, 17.13 billion. The estimate was 16.01. That's a really nice beat from Citi.
I don't see any misses here. So what is the excuse for the shares being lower, some 1.5% right now? I'm not sure. Maybe people will point to expenses like JPMorgan. We'll have to go through this. Nonetheless, it does follow the trend of the morning, which is ultimately people were waiting for the earnings to come out to sell just a little bit around the edges.
That's the broader story for earnings season so far. The early chapter, the first few pages of the first chapter of earnings season, this bar is super high. So far, Citi is down by 1.5%. So that's the earnings story for the big banks. 5 of them already reporting so far this morning. Now the story shifts towards inflation and this Federal Reserve. Coming up very shortly, 27 minutes away, CPI in America. And then a few hours after that, we hear from the Fed chair at 10 a.m. Eastern Time in front of the House Financial Services Committee.
And it almost feels like he's going to have a little pressure on him, not just because the CPI data, but what we heard yesterday from Governor Waller. Governor Waller said if we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. What is Kevin Warsh going to say when he gives his first testimony today in front of the House, tomorrow in front of the Senate, basically responding to this? Because to Bill Dudley's point, if he doesn't, then his voice just becomes less important. Others will fill that gap.
Without a doubt, if you're not going to provide guidance right now, all you're doing is outsourcing guidance to someone else on the committee. And I think we saw that yesterday, to your point. Waller filled that gap.
That is the big question today of Kevin Warsh's testimony. Will he lean into what Chris Waller said, or will he push back? And if he doesn't say anything, that's akin to almost backing it, given where the market has moved.
Yield above 425 at the front end of the curve on 2s this morning, 460-ish on 10s and north of 5% on 30s. Coming up this hour, we'll catch up with Seth Carpenter of Morgan Stanley, counting down to Kevin Warsh's testimony. Chris Marinac of Brean Capital, he's back with us, looking at how the big banks blew past Wall Street estimates, and David Kelly of JPMorgan Asset Management reacting to the latest read on inflation. Results from Citi crossing just moments ago, they were okay. Results from Goldman, JPMorgan, Wells Fargo, all doing absolutely fine. Bank of America as well. But the reaction to the story so far is that the names have dropped. We're down by 2% on Citi this morning. The beats aren't being rewarded. The misses are being punished. The conversation now shifts to inflation. We begin this hour with stocks holding steady as markets digest a slew of record-setting big bank earnings. Seth Carpenter of Morgan Stanley writing, the incoming data support patience by the Fed. Our base case remains no hike in July and no hike through year-end. Seth joins us now for more. Seth, good morning. Good to see you.
Hey, Jonathan.
What are you expecting to see in 25 minutes' time?
We're looking for core CPI to be, 20, 22 basis points, so a softening up. I think there's a clear message that we're taking from the data that core goods inflation boosted by tariffs, that's got to be coming off over time. I think there's some softness in shelter inflation. Bill Dudley was on earlier and he talked about sort of the restriction in immigration leading to less demand for housing. We think we're seeing a signal there where you're going to see some moderation continue in the shelter inflation. And so we think inflation actually is coming down. Is it going back to target right away? No. But is it coming down enough to the point where the FOMC is going to be able to say, no need to hurry, no need to hike now in July. Let's wait a couple more months and see what happens. That's what we think is the right
That's your
outcome.
forecast.
That is.
But how offside do you feel right now relative to what you're hearing from the committee?
So I think Chris Waller's a great example there. One of the points, so I was at the ECB's conference in Sintra, get this great opportunity to talk to policymakers. Everyone was talking about...
Fantastic opportunity, Seth. I'm right there with you. Good gig if you can get it.
It was great, and beautiful setting.
Without a doubt.
Everyone was talking about Kevin Warsh's sort of non-forward guidance and what you can say and what you can't say. And I think the argument in favor of Kevin's point is that markets often just listen to one part of what policymakers said. What did Chris Waller say? He said, if we get another hot inflation read, then the committee will have to consider raising interest rates soon. And what did the market do? The market sold off saying, Chris Waller just said they're likely to raise rates in July. That's not what he said. He said, if we get another hot reading, then they'll have to consider raising rates in the near future. And I think that is the tricky part with any central bank's communication. What I'd like to say to policymakers is be as clear as you can be, but under no circumstances be more clear than that.
Do you disagree with Bill Dudley that essentially the Fed's job is to take away the punch bowl when the party is really getting started and heating up? And right now, the party is pretty hot, and it seems like it might be an opportune time to start removing some of the alcohol. I mean, do you disagree with that?
So I'm not sure I fully disagree, and I think if we keep that metaphor and then put it in the context of Chris Waller's speech yesterday, they want to take the punch bowl away before things get crazy, but they're not there to try to smash all the crystal and destroy things. Chris said they want to be, they don't want to be behind the curve. They want to raise interest rates if necessary to control inflation, but they don't want to raise interest rates aggressively and risk causing a recession, and that is the inherent challenge for monetary policy since time immemorial.
Based on the earnings that we just got, based on the commentary, based in the sense that it's not just Wall Street that's going gangbusters, but you're also seeing Main Street do really well with the delinquencies coming down, what's the argument against hiking rates just once?
I think against hiking rates just once is, I don't know what hiking rates once is going to do. Hiking rates once feels a little bit of spurious precision. I think the argument to stay pat is inflation was boosted temporarily by tariffs, temporarily by the energy price shock. If it's going to settle down on its own, then let's see what the economy can do. We don't know where the unemployment rate can ultimately settle. It's been going more or less sideways, but with much less job creation. So have you slowed the economy enough to settle into this slower growth rate of the economy?
How long do you wait? 5 years, 6 years, 7 years, 10 years?
Well, so for 15 years, my job was to argue inside the institution about what monetary policy should do. That's not my job anymore. Now I have to argue over what they're likely to do.
Good fun.
If you think about the median, though, from the last FOMC meeting, there was a median of one hike this year and then a median of a cut for next year. So it's not as though the committee as a whole is champing at the bit to just really hike interest rates a lot this year.
But if you think that last year, potentially if you're an official, you think that last year was about insurance cuts, then even if it's just one hike, it's taking away that insurance.
So I think that's a reasonable argument. Were the 75 basis points worth of insurance cuts necessary, given that the labor market did not collapse? And I could see that as an argument. And so maybe you pull back on that insurance cuts. I think that is a legitimate argument that someone could make and probably has made at the FOMC table and will make in the future. Again, I could see that as a perfectly valid argument. It's just not what our baseline forecast is for what the FOMC will ultimately deliver.
I'm curious now because I want your opinion. How big is the spread between what you think the Fed should do and what they will do?
Oh, my gosh. If we go back over enough years, there's been, at times, a huge gap.
How big's the gap for you right now, personally?
The hardest part to answer that question is that we can't undo history. Our forecast was wrong when they did the insurance cuts because I probably let myself slip into the mistake of arguing over what I thought they should do as opposed to what they will do. And they did the 75 basis points worth of insurance cuts. I was not convinced at all that the labor market was weak enough that it was going to be a systemic sort of collapse in the economy. And so our forecast was wrong and they ended up cutting 75 basis points. It's a different question to say, if I could go back in time, I wouldn't do those. Versus now that we are where we are, should we hike 75 basis points and undo it? That's a very different
proposition. As an economist and strategist, if you don't mind me asking, you've learned from that experience. And I just wonder if that was a different Federal Reserve. And this is a changed Federal Reserve, a different institution, a switch in mentality, put on piles of pressure by this White House to loosen policy. And you can feel the institution sort of flexing, pushing back a little bit in some of the speeches that I've read more recently. Is this a different Fed?
So I don't think it's that dramatically a different Fed. We have a different chair. It remains to be seen specifically where Kevin Warsh's preference are for policy. The rest of the committee is unchanged. Now, you're right, they've lived through this experience. It was an insurance set of cuts, so to speak. They're a little bit past the political pressure, so maybe they want to go in the opposite direction. But then I would just argue back to where the summary of economic projections is. They only had a median of 1 rate hike for this year, and their forecast for inflation is at 3.3% for core at the end of this year. We think it's below that at 3%, and that's before you factor in this potential revision to methodology from the BEA that could lower inflation even more. So is it changed? I mean, possibly. Is it a dramatically different institution that fundamentally wants a different outcome? I don't think there's evidence of that.
Seth, it's good to see you. It always is. Thank you, Seth Carpenter there of Morgan Stanley, breaking down his experience covering this Federal Reserve. CPI drops in 28 minutes' time. About 90 minutes after that, we'll hear from the Fed chair, Kevin Warsh, on Capitol Hill.
Yeah, right now, at least the earnings seem to be supporting the idea of a insufficiently restrictive Fed, at least not restrictive policy. And now the question is, will CPI give us the insight to need forward-looking, given the fact that oil prices had gone down and are now inflecting upward, right? So you're going to have to strip those out and strip out the secondary effects that potentially could have come through. It's going to be a messy practice.
These guys are human beings. This institution is not a machine or a robot, and I can sense the personal anxiety about being above target for 5 years. And the energy story, I think, has exacerbated that anxiety more recently. And you can see AI come up repeatedly in the minutes when it concerns price pressure. And I don't know if this is about signal right now that they're looking to anchor inflation expectations by signaling a willingness to tighten monetary policy in the near term, or whether it reflects a real itch that they need to do something and do something soon.
That, I think, is the key question. Do they have to act to continue market jawboning the way that they have? Or can they say, well, next meeting might be live. We still could potentially hike, and push them back month after month after month, meeting after meeting, and still get the price reaction that they're hoping for.
This is the circular nature of the conversation right now. Chris Verrone was on the programme earlier on this morning, and he said, look, inflation expectations are well anchored. And we responded very clearly. Are they well anchored because we're priced for rate hikes? Isn't that the story right now?
What you saw was yield curve flattening as soon as you saw Kevin Warsh really reassert the independence of the Federal Reserve, this idea that there was confidence that they would inflict the necessary pain to bring down inflation should they have to. If that isn't necessarily as present in market understanding, does that shift inflation expectations in a more material way?
We're 50 basis points above the policy rate at the Federal Reserve on twos. And I remember the argument that came out of the Treasury not so long ago. When two-year yields were below the policy rate, the Treasury Secretary was making the argument that monetary policy was tight. And that was evidence for it. Now you've got a two-year trading 50 basis points above Fed funds at the upper bound of the policy rate. It's an argument right now this market is making that we're about to see high rates.
And argue that that's actually necessary, because every single banker that we talk to say that 25, 50 basis points of a rate hike isn't going to make a difference for the financing flywheel that we're hearing about from all the big banks.
And this whole conversation could change in 15 minutes' time. Two-year yields are down by 2 basis points. Sport, right? 426 on twos. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Citigroup rounding out this morning's big bank earnings. Shares lower in the pre-market even after the company reported beats across the board. Revenue from equities trading surging to a new record there as well, 45% higher than last year. IBM shares, though, sinking in the pre-market. The company reporting preliminary second quarter sales that missed analyst estimates. CEO Arvind Krishna saying that clients are shifting capital away from software and into servers, storage, memory to head off industry-wide supply shortages. Chipotle is headed to Mexico. The American company is hoping it can sell its Mexican-inspired food south of the border. Its inaugural store will open near Monterrey on Thursday, with a couple other locations planned through 2027. And that is your Bloomberg brief, John.
Hey, Vonnie, thank you. Thanks for the update. Up next, the Morning Calls Plus. Chris Marinac of Brean Capital as blowout bank earnings struggle to meet some sky-high expectations from New York City this morning. Good morning.
When when you look at the numbers across the board, they were all very good. Riding the tailwinds of the overall economy, and in particular the capital markets, is a huge impact on everybody's numbers. Investors are finally recognizing that the banking industry post-financial crisis has been de-risked.
And the numbers have been absolutely fantastic. There was Gerard Cassidy of RBC joining the program a little bit earlier, following numbers from JPMorgan, from Bank of America, from Citi, from Wells Fargo, from Goldman Sachs, knocking it out of the park. Futures this morning on the S&P down by just 0.2%, on the Nasdaq up by 0.4. At the single name level, looking at the bank sector this morning, you wouldn't really know that anything could happen. You certainly wouldn't guess that something amazing had happened, like record revenue across several business lines across many of these businesses. You don't see much evidence of that this morning at all.
No, in fact, you've got most of the bank stocks that have reported are lower on the day. The one that's the exception is Goldman Sachs, but they're just positive after blowing it out of the water. The idea that a 3% gain comes after a $7.4 billion equities trading revenue. That is 23% larger than JPMorgan's at $6 billion. It is more than double Bank of America's at $3.6 billion. So it gives you a sense it is 70% higher than it was at the same time last year. Shocking numbers. Maybe we'll give you 3%. It's probably going to fade. I mean, this is sort of how the morning's been going.
We'll see if it holds. I know I sound like a broken record, but this really is the headline so far this morning. Beats aren't being rewarded, but misses are being punished. And misses are being really, really punished, obliterated. In fact, IBM with a miss earlier on this morning, and IBM losing about a quarter of its value. IBM is down by 23% in the pre-market, and that's picking up across software names in the United States, and it's picking up across software names around the world as well. SAP over in Europe being one example of that.
Yeah, with existential risk being really at the forefront of a lot of people's minds, the idea that if software names cannot lock in big deals at a time of a lot of uncertainty, and instead a lot of corporate clients are going to the hardware, are going to cybersecurity, are putting priorities elsewhere, does this represent the SaaScopolis that people were talking about earlier, and perhaps a taste of what's to come?
Equity futures this morning then doing nothing, but bank names, software names doing a whole lot of something. Software, not so good this morning. Microsoft, IBM, Accenture trading lower in the pre-market. Let's get you some morning calls. First up, KeyBank downgrading Apple to underweight, expecting slower US demand and weak service revenue growth. The stock is down by 0.75%. Your second call from HSBC downgrading IBM to reduce and cutting its price target to a street low, saying investors can replicate its software exposure through its competitors. And your third and final call from Evercore, initiating coverage on SpaceX with an outperform rating, saying its upside potential is, quote, too compelling to ignore. That stock is up this morning by, let's call it 0.1%. Three of your calls so far this morning. Let's turn back to one of our top stories. JPMorgan, Bank of America, Goldman, Citi, all reporting earnings that beat Wall Street estimates. Joining us now is Herman Chan of Bloomberg Intelligence. Herman, let's park the price action just for a moment. Let's just go through the numbers. Sure. How phenomenal was that quarter for these banks?
Yeah, you said it right. The banks really hit it out of the park. That was really driven by equities trading results that had high expectations heading into the quarter, and the banks easily cleared that, highlighted by JPMorgan's equities trading revenue up 86% year over year. All the others that reported thus far had very similar results, so strength all across the board. Capital markets was strong as well across equities issuance, fixed income issuance, and M&A. And then your traditional banking side, decent loan growth, margins were fairly stable. So all in all, the revenue picture looks really strong.
And the environment was fantastic. The weather was tremendous. Is the next quarter, the quarter after that, going to bring more of the same?
Yeah, I think that's what a lot of the analysts will be asking for. How sustainable are these results? Recall that in the JPMorgan press release today, Jamie Dimon was a bit measured in his comments, talking about shifting tectonic plates and risk that's really, bubbling below the surface. How that changes remains to be seen. But all in all, I think you can expect the overall trading revenue environment to be really constructive, at least in the near term.
Herman, it's good to see you. As always, Herman Chan there of Bloomberg Intelligence. Chris Marinac of Brean Capital is back with us. Chris, welcome back. Let's talk about the durability of this. The tailwinds through Q2, are they durable through into year end?
Oh, I think they are, John. I think you have operating leverage from the expense side. This quarter was good. As we talked earlier, I think the lower credit costs really do matter. I think the sustainability of the bank model is quite good. we still have higher interest rates actually helping because there's a lag between any shift of higher rates on funding costs, and the banks will reset loans and earning assets faster. So I still think there's a very good case here for the widening of net interest income, net interest margin the second half of the year, and then layer over the rate of growth on expenses should be limited. That's going to help profitability continue. Plus, we still have buybacks, and we still have, I think, overall the opportunity for more business to be won as share shifts back to the banking industry.
Right now, the JPMorgan earnings call with media is ongoing, and we're hearing from both the CFO saying the U.S. consumer is a little bit stronger this quarter, so really speaking to what we've heard across the banking sector about the Main Street side of the book. And then Jamie Dimon saying that markets are booming right now, and it's pretty broad-based. Of course, we also have the caveat of there is a tipping point that can come even with such strength. What are you looking for a potential turn in the cycle, for some sort of end to what we're seeing?
Well, I think if you have stock prices go down, not just in the financial world, but really across the board, that's going to limit the opportunity to place new equity and debt. I think if you had a drop of M&A activity because, again, prices weren't cooperative, that would also be an end. But right now we're seeing the opposites. That's kind of why I think the attitude and the bullishness into third quarter and fourth is still quite good.
Chris, always good to catch up. Thanks for standing by. Chris Marinac there of Brean Capital on the bank sector so far this morning. The numbers so impressive that we've not talked about succession planning at JPMorgan once. Imagine the call might be different. There'll be lots of questions about that over at JPMorgan, but the attention firmly elsewhere.
Yeah, just to answer the question of how long it can continue and talking about how, if anything, it seems to be accelerating when it comes to the economic strength of the consumer, even if it's just a little bit. And you're hearing that across all the different companies. I mean, who's reported earnings so far? We've gotten Delta and we've gotten the big banks, and they all have come out and said that the consumer is incredibly strong. Where there is some skepticism is on the AI side of things in terms of where the money is flowing, and that's what we saw from IBM in terms of the investments. That's maybe where the fireworks come into play.
I often call earnings season cherry-picking season because we can also talk about Pepsi and story on the consumer not so great over at PepsiCo.
Yeah, although some people saying that might be a bit more of the execution thing, but you're right. You're right. Okay, cherry picking or apple picking.
It's cherry picking season.
Is it cherry season? I think it is.
Cherries are good, yeah.
Yeah, they are. They actually have been really good this season. The fruit's been very good this season.
Okay, good. So, an endorsement on fruit from Bremo. Good stuff, all right. Let's get back to inflation.
Americans weren't snacking.
How much are those cherries? CPI up next. There you go. We'll break it down with Tiffany of Pimco in just a moment. Inflation data in America, CPI, 20 seconds away. Your scores into it look like this. Equity futures on the S&P just about unchanged, down by close to 0.1%. On the Nasdaq, up by 0.6, round it up 0.7. In the bond market, 2s, 10s and 30s, yields pushing higher through yesterday's session. This morning, falling 3 basis points at the front end. 2s at 4.25, 10s at 4.60, 30s at 5%. With some breaking news, here's Mike McKee.
Good morning, John. Kevin Warsh makes no news in his prepared testimony. There is no guidance on interest rates, although he does reiterate that inflation is still the focus for the Fed. And as far as inflation is concerned, there's some particularly good news for Chairman Warsh this morning as CPI comes in down 0.4 on the month. This is the first negative print since 2026 years. Core CPI is flat for the month, and that puts the year-over-year at 3.5%, down from 4.2% for the headline, and for the core, 2.6%, down from 2.9%. Now, 1 month does not make a trend, and obviously the Fed and the White House will take credit for some of this, but they're going to have to wait and see how things break out going forward. Most of this is, as far as we can determine, from energy, of course. Now, Warsh, it's a kind of a dramatic opening he makes in his statement this morning, but again, no guidance. He says the U.S. is at a hinge point in history, and their task is to ensure that the economy excels into the future. In the text of the testimony, Warsh says the key to that is bringing inflation down. Quote, while monthly price fluctuations are inevitable, especially in an unsettled world, underlying inflation over long time horizons is determined largely by monetary policy. The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability. Now, what's missing from that statement is any mention of how they plan to do that. Whether they plan to raise or lower interest rates or hold them, nothing on that in the text. The economy, he does say, is solid. Consumer spending is moderate. Manufacturing moving up steadily, and the labor market broadly stable in his sort of economic outlook. The only laggard is housing, which is a victim of interest rates. But again, no mention of where rates are going. He does mention AI, which came up as a concern in the minutes of their last meeting. We don't know the extent to which the economy will benefit from the AI build-out, Warsh says. Even so, new opportunities for the economy introduce new challenges for policymakers. We at the Fed are monitoring the implications for inflation and the labor market. In the rest of his 6 pages, which are, by the way, about 2 pages longer than Jay Powell has had in recent years, he outlines the 5 task forces that he has appointed, and he offers praise for the late Alan Greenspan. Again, though, no policy possibilities. That'll have to wait until members get a chance to question him.
Mike McKee, thank you, buddy. Let's get to the bond market board. 2s, 10s and 30s. That's a downside surprise on CPI, and this is the sound of the door closing on a July rate hike. 2s down by 10 basis points, 4.18, removing the urgency to hike anytime soon in the minds of many, I'm sure, in this market. That can change. 10s right now down by about 8 basis points to 4.55. Turn to the equity market, unlocking this move. In equity futures, on the S&P 500, on the NASDAQ, on the Russell, the NASDAQ up by 1.3%. Your outperformance, where you'd expect there to be outperformance to be. The Russell 2000 up by 1.5%. Want to return to that quote from Governor Waller. If we get another hot reading on core inflation this week, then the FOMC will need to consider tightening monetary policy in the near term. Bramo, we got a cool reading on core CPI just moments ago.
Yeah, and that core reading came in significantly below expectations, which is the reason why you're seeing essentially what was one of the biggest moves that we've seen in the 2-year going back to September of last year. That's retraced some of it, but down more than 10 basis points at one point. People pointing to this, as you said, closing the door to a July meeting and potentially in general. What I find interesting is that the equity move is as significant. And I'm looking, for example, at the shares of Goldman Sachs taking another leg higher on the heels of that. How much does this just add fuel to the enthusiasm that we're seeing in some of these earnings that we've gotten this morning?
Well, let's start on the rate debate. So in the near term, the urgency to hike. We had a soft payrolls report. You've had a soft CPI. I think in the near term, you remove some of the urgency. But does it settle the debate? I don't think so. Not with core inflation still closer to 3 than it is to 2. Anxiety that we've been above target for 5 years. Unemployment close to 4%. And sticky inflation around themes like AI is going to keep these guys on the back foot for the time being. Now, when the chairman is going to come out and say we've got no tolerance for above target inflation, let's work with that. What does that mean in practice? That's what we need to get into today. You've said this a few times now, and I hear this from various guests, and I heard it from Mike McKee just moments ago. We've heard this repeatedly from you. What do you intend to do about it? We understand now. We've got the picture. I've heard the message loud and clear. What are you going to lead the committee to do to counter it?
Yeah. Is it going to be something that can be executed with rates? Is it going to be balance sheet? Is it something else? And do you think that you can afford to wait for the task forces to be done before you make any of those decisions? Do you think that the Fed can be put on hold while deliberations continue? And if not, do you think that you are supportive of your potential colleagues who are giving guidance and are affecting market pricing? I mean, again, there's some really important questions, and if he doesn't answer them, that will speak as loudly as if he does.
Because removing the urgency to hike and settling the debate to hike are two different things this morning. And with 2 still around 4.18, yes, we're seeing a 10 basis point move lower. We're taking back the Waller sell-off in some ways. You're removing the urgency. Do you settle the debate this far, this high, above the policy rate? Fed funds right now 50 basis points lower than where 2s are. I don't think you've settled the debate just yet.
And just to build on that, oil prices did come in, which was a big part of the headline number, declining for the first decline going back 6 years. On the flip side, oil prices are inflecting higher again. How do you factor that in, given the fact that the pass-through is significant, and it's not just coming in the form of gasoline prices, but also diesel prices, food prices, pretty much the inputs for everything that people buy?
We've turned down the heat on the stove, but this debate is still simmering. Mike McKee's got a second look at this inflation data. Mike, what do you see?
Well, food prices did rise 0.2%, but gasoline wiped out all of those gains. Gasoline down 9.7%, more than accounting for all of the decline in the CPI this month. New cars were flat. Apparel prices were down 0.6 on the month, and used car prices were down 0.2%. Owner's equivalent rent up just 0.2% after a string of readings above that level. And airline fares were up only 0.2%. Remember, we were watching them rise because of the price of jet fuel. So a lot of things down in price this month. But as Lisa just pointed out, the war back on, some of those things are going to go back up again in the July reading. So while it does probably eliminate the idea of a July rate increase, it doesn't take it out of the room for them to discuss.
Mike, looking forward to your coverage of the testimony later this morning. Mike McKee there breaking down the inflation data and the prepared testimony from the Fed Chair, Kevin Warsh. He confronts the House Financial Services Committee at 10 a.m. Eastern Time. I'm sure it won't be that combative with the Chairman, French Show, a little bit later this morning. And then tomorrow, in front of the Senate Banking Committee, 2 days on Capitol Hill. I don't envy that. Can you imagine that? 2 days on Capitol Hill, in front of the House, then the Senate, to talk monetary policy and all these crazy questions about finance and the backdrop right now.
What's the pre-hearing breakfast? I mean, seriously, because you have to really have enough energy to get through it.
Got a carb load.
Yeah, carb load, do training, sing Eye of the Storm in the bathroom while beating your chest.
Is that what you do, Bremo?
She's on the David
No
Guetta
comment.
David Guetta kick.
Eye of the Storm? In the shower?
I did that once. Not in the shower, but moving on.
If that's what you do in the morning, like stretches to like hype socks, like Rocky. OK, all right. Tiffany Welding and Pimco joins us now for more. Tiffany, not more of that. We'll talk about the data. What's your reaction to CPI dropping just moments ago?
Yeah, well, I thought you guys laid out a very key list of questions there that Chairman Warsh and the FOMC committee will have to answer over the coming months and quarters. I think in addition to those questions that you laid out, one of the key ones has been this year. What is really driving inflation? Is it a kind of a sequence of supply shocks and one-time price level adjustments, or are we genuinely seeing some resilient demand that is lifting inflation? And I lay out that question because it's really key to how monetary policy makers should react to what we're seeing. If it is indeed just a series of supply shocks, then they can afford to be patient. But if it's not and it's underlying demand, then that's when you really need to offset that with higher interest rates. And I think there's certainly evidence that supply-related factors are contributing here, but there's some ambiguousness as well. And I think Waller sort of laid out the case yesterday to basically say the longer that we get a continued sequence of elevated inflation prints, the more the case builds that this is really demand that's keeping inflation elevated as well. So I think this data today will be a sigh of relief for many FOMC members. As you guys suggested, it won't close the door to interest rate hikes in general, but it basically is now a nod in the direction that, yes, we did get some one-off tariff adjustments. Certainly energy prices are not back to the war-related levels yet. And we're getting this sort of AI-related price increases in tech components and stuff like that. So, I think this print does suggest that, there's reason to believe that cools down in the second half of the year. But clearly the onus is on the data. It needs to cool down for them to hold. And I think Waller again really laid out the case that we could need some modest adjustments higher, if inflation continues to rise.
It gives them the time, if they want it, the much needed time to have a longer conversation through the summer. Tiffany, it takes me to this quote from Kevin Warsh, the Fed chair. Prepared testimony, and he says this: "The members of our committee have no tolerance for persistently elevated inflation, and we share a resolute commitment to restoring price stability." So, Tiffany, we have seen persistently above target inflation, and they have tolerated it for 5 years. When he says we share a resolute commitment to restoring price stability, what's your best guess as to what he means and what they intend to do about it?
Yeah, well, I mean, I think he's clearly, saying that, he wants to maintain a Federal Reserve that the markets view as credible, because ultimately in the longer run, if you have price stability, that's good for the economy. He wants to manage inflation expectations. He wants to make sure that they're anchored, because ultimately that keeps that results in an easier job for the Federal Reserve if inflation expectations are anchored, in order to get that price stability. So he is clearly saying the right things here in terms of keeping those inflation expectations anchored. But at some point, if inflation does turn out to be more of a demand-driven phenomenon above target inflation, if you have several more years of that, then again the risk is that you have inflation expectations that are starting to drift higher, and the Fed does have to react. I think they are, and I think Chairman Warsh is basically saying we're prepared to act if we need to, but as of right now, at least with today's print, it does buy them a little bit more time to see a little bit more data and to maybe clear up some of that ambiguity that we're seeing in terms of demand or supply related factors driving inflation.
Tiffany, how long can jawboning work without action? In other words, how long can they signal that they are willing to act without acting with inflation squarely above that 2% target?
Yeah, well, I mean, I certainly think that, at some point, if the data is not, and if inflation is not going in their direction, absolutely, they will need to act. But as of right now, at least, if you have a sequence of inflation prints that are, are giving you more evidence that inflation is headed back to target, then I think, again, that kind of buys you a little bit more time. I mean, we have had just an unfortunate set of, sort of events with the increase in energy prices, of course, tariff-related inflation, inflation that was coming on the back of the pandemic, which was both supply and demand-related factors. All of that has just kept inflation above target. We think the Federal Reserve has done a very good job, certainly at bringing it back down. And of course, as we look forward, we expect them to continue to do that and work to moderate inflation.
Tiffany, it's good to see you. Always is. Tiffany Wilding there of Pimco, getting up early on the West Coast to look at this data. I don't know how they do it over at Pimco.
I don't either. I mean, waking up at what, 4?
Right, over in Newport.
Can you imagine waking up at 4?
At 4? I do that every morning. Wake up at 3.
I'm kidding, at 3.
But they've got to be in the office at like 3.
Sometimes I don't go to bed.
Right?
Yeah, it's true.
Crazy. Let's get back to that data. So CPI. Core CPI, month over month, coming in at 0. The expectation, the estimate in our survey was positive 0.2. So year over year, we go to 2.6, down from 2.9. The estimate was 2.8. So that's a material improvement there. Of course, when you look at headline in at negative 0.4, the expectation was negative 0.1. Month over month, I'm talking about here. Year over year, headline inflation comes in at 3.5 against an estimate of 3.8. Certainly, it's better than 4.2. And far better than 3.8. There's some energy noise in this. And energy, of course, this morning is bouncing back. So this can be noisy again in the next month or so. The conclusion, though, the early conclusion on Wall Street is this will remove, again, some urgency to hike interest rates, but it won't completely settle the debate with inflation still above target, where it has been for much of the last 5 years or so. So what do you see in the market? Front end of the curve, a rally. 2's down 10. Down 10 basis points at the front end of the curve. Got that. Once you see that in the bond market, you can guess the equity market reaction. Equity futures up across the board. The S&P up by 1/3. Outperformance on the Russell. NASDAQ futures doing nicely. The Russell this morning up by 1 percentage point. Chairman Warsh is the next risk event on the horizon. He's saying the committee won't tolerate persistently above target inflation. But inflation has been above target persistently now for 5 years. When they talk about doing something about it, how credible is that? Or is that just a communication exercise? Because what I just heard from Tiffany was essentially the latter, that it's just a communication exercise at this point.
That's the speculation on Wall Street right now, and that's the reason why you're seeing the reaction in markets. This will be a good excuse for them to hold off, that the bias is still to not hike rates if they can, not necessarily to use any data point as an excuse to hike. That is a difference between an easing bias or a hiking bias, and it's still underneath this Federal Reserve, there is ultimately more of an easing bias than a hiking bias. I don't know if that's the case, and I don't know if we're going to hear anything from Chair Warsh ultimately, if he doesn't say anything, is that going to feed the credibility argument or not? I mean, ultimately, we're just going to be playing the Rorschach test of who is Kevin Warsh.
Someone else will do the communication for him, and we saw that yesterday from Chris Waller, the Fed governor. The Fed chair is 1 hour and 15 minutes away. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Well, let's recap the inflation data we just got moments ago. June CPI falling 0.4% from a month ago. It's the first negative print since 2020, and likely, as you say, takes some pressure off the Fed to raise interest rates, at least in July. Fed Chair Kevin Warsh set to testify before the House Financial Services Committee at 10 Eastern. In his opening statement published moments ago, Warsh saying the FOMC has, quote, no tolerance for persistently elevated inflation and remains committed to restoring price stability. South Carolina's governor appointing the sister of the late U.S. Senator Lindsey Graham to serve out the remainder of his term through January. Her appointment comes as Republicans prepare for an August primary to choose the party's candidate for a full 6-year term. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead. Plus, we'll catch up with David Kelly of JPMorgan Asset Management.
It's really key to how monetary policymakers should react to what we're seeing. If it is indeed just a series of supply shocks, then they can afford to be patient. But if it's not, and it's underlying demand, then that's when you really need to offset that with higher interest rates.
Can we just say thanks to Robin Vince over at BNY, to Ted Pick over at Morgan Stanley for choosing tomorrow to report earnings and not today with everybody else.
We could take a breath,
right?
Drink our coffee, look at their earnings. Thank you.
What a morning. We've had 5 banks reporting earnings already this morning. We've had CPI. So on the bank side of things, the test. Super sky high expectations, some beats here and there, insufficient to generate a big rally. And then we got some better news. CPI just below expectations, significantly below by some measure, unlocking these gains. Cross-asset. Equity futures higher by 0.25% on the S&P. On the Nasdaq, up by 1 full percentage point. And the bond market yields dropping at the front end of the curve. Bramo, we're down 10 on twos.
Taking a July rate hike off the table. Question is, how much are we going to see Kevin Warsh take a rate hike off the table for the rest of the year? Ultimately, it's going to be really how do you execute price stability at a time where we haven't gotten that for more than 5 years?
Investors looking ahead to Fed Chair Kevin Warsh's testimony on Capitol Hill. That starts in about 1 hour and 10 minutes time. David Kelly of JPMorgan Asset Management joins us now for more. David, welcome, sir. Always good to hear from you. Your reflections on what we saw in the data moments ago and what you anticipate to hear from the Fed Chair later this morning, please.
Well, first of all, the news on inflation is good. It was better than expected. Usually if that happens, it's because of some special factors. And if you dig into the data, we saw a decline in airline fares, but we saw a 1% decline in electricity prices that bounces around a lot month to month. We saw a 2% decline in auto insurance. Remember, that one was causing a huge problem a few years ago. We saw a big decline in tobacco prices. So these are special factors which is causing the decline in inflation that we've expected all along to occur a little faster than we thought. But overall, we don't have an underlying inflation problem, at least not one that monetary policy can solve. This is the inflation caused by the tariffs, by the oil shock, by the fact that shelter costs just don't keep up with the real world. And it is gradually fixing itself. So I think inflation's on the right track here. It's coming down. I think it will be just a little over 3% by December. I think it would be down at 2% year over year by next May. I don't think the Fed should do anything. We'll have to see. We'll have to see what Chairman Warsh says. I think he'll talk tough. But ultimately, I don't think the Fed does anything this year.
David, a lot of people have come on the show, including Bill Dudley, formerly of the New York Fed, and talked about how he sees a lot of places where inflation seems to be picking up, and not only tied to AI spending and all of the issues that you mentioned, like tariffs and oil prices, but consumers are spending, and the upper end of the K is doing very well. Delta's saying that they're going to raise prices more if oil prices go back up. Where do you see the progress being made so significantly?
Well, I think what we're not seeing is a liftoff in the spending of lower and middle income consumers. Yes, the upper end of the K is doing well, and I suppose that's going to push up the cost of expensive restaurants and so forth. But we're not really seeing that much in airline fares because it is a very competitive industry. And more than that, I think the big thing that we're not talking about is the demographic drag here. Population growth in the United States, at least the population of adults, has essentially slowed to a halt. because of what's happened with immigration. Now, the result of that is we're now at an 8-year high on rental vacancy rates. We've got an extremely high number on unsold new homes. That is dampening down the cost of housing. It's dampening down demographic demand for a lot of basic goods and services. And so I think a lot of the basics are not seeing a lot of inflation. I understand people think the prices are high. Of course they're high. But the rate of increase in prices is low because, frankly, you're not seeing lower middle income households have gains in real income that would allow them to spend more in these areas. So I'm not seeing it broadly. I'm seeing it at the upper end, but not broadly.
David, what do you make then of Governor Waller saying no matter how you cut it or what measure you want to use, inflation is up this year? At some point, don't they need to address that, the fact that it is up and it has been up for 5-6 years?
I think that central bankers think that monetary policy has got much more to do with this than it actually does. Look, we got inflation in 2022 because of the pandemic, the policy response in Ukraine. We got inflation in 2026 because of tariffs, of the Iran war, and some legacy of these high shelter costs. But it's not caused by an increase in the quantity of money. It's not really being caused by interest rates being too high or too low. That's not what's causing it. And the economy will heal itself. Inflation will heal itself at a measured pace if if Washington just leaves it alone. And for my mind, interest rates are about at a reasonable place. The Federal Reserve should not mess around with them and not pretend that they're the ones that are actually governing the inflation rate, because they're not.
David, it's good to see you. As always, sir, it's been your message for quite some time. They need to stay out of the way. David Kelly of JPMorgan Asset Management. Stay out of the way across several dimensions, including maybe the Middle East, because right now, crude's bouncing back, and these numbers we're comfortable with this morning could change in a month's time.
Yeah, because a lot of these inputs really are directly connected to the price of oil, and not just oil, but also the distillates, because that is the refineries that haven't necessarily come back online. This is going to be the key question. Do you see this natural process that can bring us down to 2% still in effect, or have there been enough one-offs to shake the confidence not only of the Federal Reserve, but also of markets that maybe are adjusting their inflation expectations to the expectation for rate hikes, not for remaining on hold?
One more risk event to go. 2 down. Bank earnings behind us, for this morning at least. CPI better than expected. Kevin Warsh, Fed Chair, an hour away. Coming up tomorrow, Steve Chevrone of Federated, Ed Yardeni of Yardeni Research, the BNY CFO Dermot McDonough, and the former US Commerce Secretary Gina Raimondo. From New York City this morning, good morning, what a morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.